Ladies and gentlemen, we have another big earnings day. So not only do we have, the trade desk and Chime, which we'll be able to listen to simultaneously, or sorry, not simultaneously, but back to back sequentially. Rocket Lab, Soundhound, Block, Pinterest, Kratos, MP Materials, SMR. There's going to be so many names today. We're going to try to squeeze all of them in. And wow, it should be a really, really big day. So strap in, get ready for a packed amount of new earnings. And most excitingly, I think like Rocket Lab obviously is going to be really cool. But Chime, we are going to be able to listen to for the first ever time. We've never heard management talk on an earnings call. This is their first ever one. We've only seen the S1 before that. So we only have 1 point of data really to go off of. Pinterest, Kratos, MP Materials, they've been around a long time. Soundhound's been around a decent amount of time. So we'll get their numbers as well. Really excited about that. And I think there were other names as well. Stone Co., ABCL, TripAdvisors, all these ones, Flutter. These ones will be interesting as well. So let's make sure that we have all of these loaded in and we can get to watching some of these exciting earnings calls. Chime going up a little bit on the day. By the way, Firefly ended up IPOing today, up 33%. White Fiber down 4% on their IPO after jumping up nearly 40%. Quick sell-off there. Rocket Lab, Block, Chime. What are some other ones that we have? We need ABCL. We need Stone. Texas Roadhouse. That's another great one. Good idea. Monster. There's going to be a bunch. And then so in the next couple minutes, we're going to be jumping over to looking at all of these numbers, and they're going to start releasing all at the exact same time. The call for Chime, though, is not at 5 o'clock. It's actually at 6. So I'm going to be live on this call for quite a while. We're going to listen to the trade desk first because that goes off at 5. Okay. Then we're going to transition over to Chime, the trade desk at 5, Chime at 6 to 7. And I will try to put chapters on this. So in case you guys want to come back and watch those calls, if you're more interested in Chime or whatever, it is a while till those come out. But remember, we have earnings. Like it's not just about the call, it's about the numbers as well. So we're going to be able to see their first ever earnings results presentation. That should also be very big as well. So that would be very interesting. Let's see MP Materials. They're going to have a very interesting call as well. What did I not add? Did I even put up pins here? Pins. We have Rocket Lab, Block, Chime, SMR, Soundhound, TripAdvisor. Do we have them all? We have Take-Two, but I don't really care about Take-Two until GTA 6 comes out. I don't know if you guys have a differing opinion. We can also put Sezzle up there. That might be an interesting one. Very fast-flying name in the past year or so. I don't know if you guys want Expedia Group, GoDaddy, any of these on there as well. I mean, we can... I might be interested in Expedia Group just for the travel industry. That might be interesting. Let me know if you guys want, JFrog or Live Nation. It is going to be a busy day. We have so many names to cover. I guess we could just put them all on. Well, not all. I mean, there's way too many, but put Flutter. We'll put Live Nation just in case if they end up running. Okay. There we go. And there we go. So we should be hitting off into overnight right now. That means earnings can start releasing immediately. So let's make sure that we have the news up to try to receive these numbers as they come in. We're not going to be as fast as Bloomberg, but we'll try to be quick nonetheless. Pinterest up 1.5%. That's probably the first sign of good earnings from them. In the after hours, MP Materials up 0.8. Remember, the small movements, 1% from Stoneco. Some of these can just be immediate, earnings jitters. But we will keep an eye on them. Block flat, SMR roughly flat. JFrog down another 4% after dropping 7% on the day. That's definitely not a good sign. Wow. Let's actually, I'm going to flip this. I'm going to put my stream up there so I don't have to just crank my neck the whole time. I'll put this over here. Got to redo all these monitors. Yeah, Soundhound is here as well. We're going to be listening to we're going to be watching Soundhound as well. Soundhound right here up 1.6%. And can we also look at Rocket Lab? Rocket Lab's here as well, up 1.5%. We're going to get numbers for both of those. I'm very excited for both. The trade desk numbers are out. EPS flat, in line, 41 cents expected, only up 5% year over year. And revenue came in essentially flat as well, up just 1%. Beat by 1%, up 19% year over year. Not the greatest sign for the trade desk. Do I not even have TTD up here? That's crazy. Yeah, down 16. Unbelievable news. It's definitely not what we saw from AppLovin yesterday. So I understand the reaction. Not happy about that. That's in my stock draft as well and in my own portfolio. Sucks. Well, we'll have to hear what Jeff Green has to say. I mean, that's absolutely devastating. Now down 24%. Jeez. If it's more transition talk, I'm not going to be too happy. Expedia up 7.8%. Pinterest up 1%. Let's see any other high-flying names here. Chime flat in after hours. SMR flat. Everything else looks relatively flat. I mean, I don't think you could have picked a worse name than TTD to cover earnings. Wow. That's just the luck of the draw, I guess. Absolutely incredible. We see... Is Blocknut up here? Oh my gosh, how did I miss some of these big names? We'll throw the big ones up to the top so I don't have to keep looking. We'll throw Chime up there again, just so it's right at the top, and then we'll throw, what is it? Soundhound and Rocket Lab. There we go. Man, I thought I was going to get away with good earnings this time. I mean, AppLovin had recovered yesterday. $64 now. I'm going to have to really see what those earnings were like, because if it's something that is spooking the market but is a little bit overblown, might be a decent time for me to well, actually not even lower my average, because I got in at pretty good pricing, but and before them joining the S&P 500. But we'll have to see what they end up saying about earnings. I have the presentation here as well. Let's see what they ended up saying. Bear with me, and let's make sure that we have other. Oh, Block starting to run, up 4%, nearly up 5%. Soundhound up 2.5%. Let me try to get numbers on these. We only got the trade desk right out of the gate, seeming like it's going to be a little bit longer on the other ones. However, I do have the press release. Oh, yeah. Yeah, revenue only grew 19% for the trade desk. Definitely not what people wanted to see. Net income margin of only 13%, making 18 cents of diluted EPS. Adjusted EBITDA margin shrank a little bit. I mean, these are not good signs. Let's see what this is about. Customer retention remained over 95%. as it has for the past 11 years. Let's see. The trade desk is building support for Unified ID 2.0. OpenPath gives our clients simplified. No, let's see what they had to say about this actual quarter. Next, so third quarter guidance, 717 million of revenue, adjusted EBITDA of 277 million. So that is not looking like the biggest increase. That's almost flat quarter over quarter. These are not good signs for their expected growth. And adjusted EBITDA of 277 is a few million more than what they did this quarter. These are not good signs. Of course, it's selling off. Block up 10%. Let's see if there's numbers released on that, because I'm super curious to see. Block ended up missing revenue by 4%. Revenue ended up decreasing year over year by 2%. However, EPS beat by 28%. Quarter over quarter, EPS grew 55%. However, EPS year over year shrank by 6%. It'll be interesting to get more details along that and which segment actually grew, whether it was Cash App or Square, potentially other parts of the business. That will be quite interesting as well. App is greater than TTD. I mean, it might be at this point, eh? Even with the added market cap, there's a reason to show that they could be performing better on into the future. Expedia now up 12.5%. What is it? Instacart up 3.5%, nearly 4% now. CleanSpark up 3%. The Trade Desk down 3.5%. And SMR up 2%. Expedia is a big name here. Block's a big name today. Soundhound up 5.8%. Oh, I want the numbers on Soundhound. Wow, do I ever want the news on Soundhound. I also have Expedia's numbers fully broken out here. Revenue ended up beating estimates by nearly $90 million, up 6% year over year. Adjusted EPS beat by quite a large margin, actually. Holy, beat by about 11% or so, up 21% year over year. Gross bookings for full year guidance got raised. Revenue got raised for full year guidance, and margins ended up getting raised as well. No wonder Expedia is up nearly 14%. That makes a ton of sense. Soundhound up nearly 8% now, 8%. I'm going to try to get some more details on Soundhound, but before I do, CleanSpark ended up beating EPS by quite a large margin, 56%, while missing revenue by just 1%. However, revenue is up 91% year over year. EPS is up 176%. That is incredible. Absolutely incredible. For Expedia, really quickly, B2B gross bookings is up 17% year over year. B2C gross bookings up 1%. Lodging gross bookings up 6%. Hotel bookings up 8%. B2B revenue was up 15%. However, gross bookings actually up 17%. And advertising revenue was up 19%. I mean, they're doing very, very well. Why the TTD dip? I mean, they just didn't perform. They came in right in line with their own expectations, not beating out the way that other advertisers did in the space. And their next quarter guidance looks a little whack. Got to be honest with you. EPS, let's see here. Guidance, they expect to come in at 717 million. It was 718 is what Wall Street was expecting for Q3. But here is some things that they've ended up updating. They put Alex Kyle as CFO effective August 21st, previously at Salesforce and Lightspeed Ventures. The outgoing CFO will remain through year end as a non-executive officer. They had some new people join the board. They said that they were going to do this, was appointing a bunch of new C-suite as they scale and change the business. So we kind of knew that that was going to happen. They did buybacks of $261 million in Q2 and have remaining buyback authorization of $375 million. Jeff Green ended up saying that Q2 was a strong quarter. We continue to outpace the digital ad market. And Kokai and OpenPath are unlocking major innovation across the open internet. We're delivering exceptional value and empowering the world's largest brands. Yeah. Not what the market wants to hear. I mean, outpacing the market is great, but the valuation on your stock is not just assuming that you are slightly outpacing the market. You have 100 plus PE. People want to see some real growth here, or else the margin or the multiple is heavily extended. Block up 8. JFrog ended up turning around, being down nearly down 4% to now being up over 13.5% in the after hours after falling 7% on the day. Instacart up 17%, 19. Wow. That is incredible. They're about to break 20% here. That's absolutely insane. Monster Beverage showing why they're the best company to have ever invested in, which is a true statistic, by the way. If you look back at where you could have purchased this stock back in 1996 to today, you're up 444,000%. The best company in the stock market to have invested in. And now they're up another 7.5% in after hours. So congratulations to the Monster Beverage investors. Instacart now up 24%. Let's see if we can get some data on that. Let's see. I only have block news, so let's move on to that until Instacart ends up coming in. Block right now up 8%. Missing on EPS just slightly, 62 cents versus 67 cents expected. Gross profit and operating income for next quarter ended up getting raised. Actually, not for next quarter, for full year of 2025 got raised. Q3 ended up getting raised as well, but not as large, about $60 million worth. Okay. Jack Dorsey said, we are raising our guidance to reflect the strength we are seeing across our business. Those are strong words. And Cash App gross profit ended up beating expectations, coming in at 1.5 billion versus 1.42 expected. So good turnaround from Jack, if possible. Soundhound, let's see if we can get some data on that. It has not come through on my charts yet, but the stock is up 7.8%. Instacart just came in. Let's see Instacart really quickly. Where's Instacart? Up nearly 11%. Wow, that growth just got cut in half. Growth cut in half from Instacart. EPS came in line. Revenue was up 11%, beat by nearly $18 million from 914, which is what they actually reported. Q3 guide was larger than expected. They had more GTV than expected at 9 billion versus 8.94 billion expected. 82.7 million orders, 2 million more than expected. Average order value was down 5%, impacted by restaurant mix and Instacart Plus basket minimums. And gross profit margin was better than expected, and adjusted EBITDA margin was also better than expected. They came in at a 29% margin. They were expecting 27.5%. Slight beats across the board. Average order value decreased 5%, but that was due to restaurant orders and waived fees for Instacart Plus. Flat transaction revenue percentage to GTV driven by offsetting factors and efficiency gains led to lower adjusted OPEX as a percentage of GTV. GoDaddy ended up being pretty in line. We can add this name, but I think they're just going to be pretty flat just based off the numbers that I'm seeing right here. Yeah, 2%. Negative 2%, I should say. Rocket Lab up 2. It'd be nice to get some CEO commentary there. Looking like it might end up breaking out. I don't have the numbers here, but that, yep, it just looked like one of those moments. Kratos as well. Let's add this. This looks good. Well, guide doesn't look so great. Yeah, negative 1%. Soundhound up 6. Rocket Lab now up 5%. 6% Matt Money going to be pulling away. That is just incredible. Let's see what else we have. The trade desk, how is it? Oh, guys, you don't want me, if you haven't seen, I don't know if you want me to bring it up. Down 26.7%. It is a bloodbath. Absolute bloodbath, if you ask me. But, I mean, for the most part, they did all right. They just didn't do a smashing beat like what their competitors had done. Every advertising space showed pretty great growth. And they're beating revenue estimates and EBITDA estimates by 1%, 3%, stuff like this. But the valuation that they are justifying right now is very high. Yes, TTD is still growing, and they're growing faster than their competitors, but that's not what the market wants to see. It's not that companies are either growing or dying. There's a whole spectrum of companies that are actually dying to slowly or to quickly dying to slowly dying to maintaining to growing to accelerating to hyper growth to Palantir. Okay. And even further, Nvidia. If the trade desk is being priced as a hyper growth business, but they're actually coming in as just slight beats, that means that the company needs to be repriced. And that if a company moves by 20% in a couple minute period, that is a repricing of the stock. Okay. Is a revaluation. Is it an overreaction? I don't know. I don't know if I would make that call before we end up hearing the numbers. If you were to talk about AppLovin, was that an overreaction? Yes, and we ended up seeing that play out. We can see from AppLovin here that yesterday we ended up seeing a sell-off all the way down to, nearly negative 13% at one point, and then climbing back up. And then in the morning ended up being realized for what the earnings really were, and it ended up jumping up another 12%. So I was able to buy the dip roughly around, if we can zoom in here, why won't it let me grab this? The stock yesterday, we were able to get shares around 361. So right in here. Okay. And now it looks like we made a genius move. But back then it was not so clear because the earnings were definitely not as great as people were wanting. Should it be down 28%? I don't know. I'm going to continue to read through their earnings to make sure, but I'm not chomping at the bit to buy more if what I'm buying into is a company that is not able to re-accelerate growth and is in fact actually hitting some mature levels. Maybe it's a problem. Now, if they really do believe that Google is going to be stepping out of their space and there's a massive new market to enter into, that could be a big deal. But next quarter's guidance does not excite me. That's for dang sure. Let's see. Let's go through here. Kratos down 4%. GoDaddy down 3.5%. Soundhound. Let's get some numbers on Soundhound. Can we, please? I want to see what they ended up putting up. Wow, team ended up posting really big numbers. Flat on the day. I mean, they beat by 15%. Revenue beats. Absolute double beat. Absolute. But the stock stays flat. JFrog up 15%. Expedia up 15%. Let's scroll down. Stoneco up 2%. Texas Roadhouse down 3.7%. Monster Beverage up 4% now. Much higher earlier on. Those are really the names that are making massive moves. Take-Two Interactive starting to really spike up. That's incredible. I mean, is it worth a 30% sell-off? Oh, wow. That's a lot. I don't know if it's worth a 30% sell-off. you're cutting the company. Like, you're saying it's only worth 60% or 70% of what it was worth before. That's a big bar. Down 3-0, that's big. Let's find some Soundhound news. I have waited long enough. I'm going to go searching for it myself. If it doesn't appear on my screen, we go looking. Soundhound earnings. EPS ended up going positive. EPS is essentially up 358% year over year. It beat by 444%. Revenue, although missing by 4%, is still up 151% year over year. But revenue is actually down 16% quarter over quarter. Very interesting. The only problem that I have with Soundhound, especially missing or declining in revenue quarter over quarter, is look at the valuation on this company. It's insane. You know, down 47% year to date, up 139% over the full year, however. Yeah, it's good growth, but the market also seems to price it in pretty well. Block now up 12%, but even when it's up 12%, we're at $86 a share, which just goes to show you how oversold this company was. I mean, we got out of this company, I don't remember how long ago, 6-9 months ago. It was like $90 a share. So it's still not even back to where we sold it from since then. And as long as I wasn't buying TTD during that time, I should have been fine. However, probably some of the money went into TTD. It's one of my smallest positions. So, like, I promise you guys I'm not sweating it, but it always sucks to pick a name that ends up going down. I was really hoping this was going to be the breakout quarter. We saw advertising do so freaking well. And, we saw the recovery from last quarter, this massive run up, like complete disrespect of the company. Next quarter, we ended up seeing a massive breakout. I was hoping for a breakout that led us back into the areas of last time. However, we're going to open up down to about here tomorrow, which is insane. Absolutely incredible. Oh, well, that's the nature of this game. It's just how you respond to this type of move. Because if I hear the call, and Jeff Green can be a very convincing guy, but if I'm not convinced, I'll cut my losses and move into names that I have higher conviction on. Because if you find names that have 30+% moves on earnings, that is pretty insane. By the way, Chime, someone mentioned Chime in the chat. Chime, I didn't see any numbers. I'm on the website right now. They don't have anything. Now, this is their first time posting earnings. So I don't know if they're going to be late. By the way, their earnings call is at 6 o'clock. So I don't know if they plan to put out the actual report at 5. And because they don't have any historic data, I can't even get a assumption for whenever they put out their earnings. It's not currently out. Let me check to see. Yeah, there's absolutely no expectation for when they drop their earnings. It's unfortunate. Rocket Lab, very volatile, but potentially trying to head into new highs here in the after hours. Not for all-time high of the stock, but of this after-hour session, up 6+%. And honestly, the news on TTD, it's not like they dropped the ball anywhere. It's just that the multiple on the company was expecting really good results. And 19% growth is not all that for a company with over 100 PE. We are paying a premium. Going to Block really quick, up 10%. They essentially beat expectations for Square, just very slightly, but still more than expected. Take rate actually went slightly down, I think, on Square. Cash App, and that's just from first view. I'm just looking at how much the gross profit changed versus how much GPV volume they actually had, and it looked like gross profit did not expand as fast as GPV. Cash App ended up doing much better, bringing in about $60 million more than expectations. Monthly active users stayed absolutely flat, so I'm not going to touch this one. And Cash Card monthly active users ended up expanding 1 million more quarter over quarter. It doesn't mean there's a million change. It means that it's fully rounded and they don't show decimal points. So the most we can see is that they've gained roughly about 500,000 new cards, which is decent. I don't have anything against Block, but I'm not going to be touching it until they start growing users once again. JFrog up 13.7%. I haven't heard a peep about that just yet, but we'll try to find that. Take-Two Interactive beat on EPS by nearly 90% and beat on revenue by 6%. That is a killing quarter. Pinterest. Do we not have pins on the list? Oh my gosh. Pins down 10. Miss on EPS by 6%. Revenue beat by 2%. EPS came in 14% year over year, and revenue was 17% year over year. Rocket Lab numbers, if we didn't cover this already. EPS, now I don't have the full report, so a lot of this company is going to lead into commentary about what they're doing next, okay? But EPS came in missing by 18%. We're starting to see the stock maybe react to this. And revenue ended up beating by 7% to 144 million, 144.4 million. EPS was down 63% year over year, while revenue increased 63% year over year. What the heck? I just got Soundhound numbers, but they're different than the last numbers I just read. The Soundhound numbers that I'm seeing now is that EPS was actually worse than expected, and I'm going to have to check the actual report because I think that the data that is being scraped here is not correct, because it's saying that revenue is accelerating in a beat, but yet the profit ended up not doing as well, which from what I read before, that was not the case. Yeah, it looks like the new information that I'm getting is actually more correct than the last one. So I apologize on the last report. It looked like whoever was scraping that data ended up getting it incorrect. Revenue was actually reported 42.7 million, an increase of 217%. This is directly off their website. So I'm 100% certain. Chime is down. Okay, we'll have to check Chime, but this is directly off of their website now. Gross profit margin of 39%, non-GAAP gross margin of 58.4%, net losses of 37.4 million. And if we go back to the stock here, now that I know that I have now that I know that I have the right information, I can go back to looking at what Wall Street was expecting. So they missed on EPS by roughly 90% and beat on revenue by roughly 30%. If you're expecting a company that is taking market share and not too worried about the profitability at this current time, I guess that's exactly what you want to see. Chime down 7 on their first report. Let's go take a look. I'm not expecting big numbers from them, considering we saw, we have the webcast and their first ever earnings supplement as well. Strong top-line momentum with 37% year-over-year revenue growth, 23% year-over-year active member growth, highlighting successful top-of-funnel execution. I mean, you're not doing it as great as SoFi, but you can say you're doing it. But yeah, go ahead. Revenue is 528 million, up 37% year-over-year. Payments grew by 19% year-over-year, but platform-related revenue, I'm excited to see what constitutes platform-related revenue is up 113% year over year. Much smaller line item, but still, that is incredible growth rate. They have an 87% gross margin on their gross profit of $461 million. Insane, but that's what fintechs can do. And net loss, what? Net loss was $923 million at a net margin of 175%. Okay, it's not terrible. It's because they went public. Okay. The increase in net loss was primarily due to $928 million. So they actually would have been positive by $5 million of stock-based compensation expense and related payroll expense, significantly elevated in the period due to our initial public offering. Okay, fine. That is fine. Someone said that the trade desk is coming back. I don't know what chart you're looking at, brother. We're at 28.5%. If you're saying this is coming back, zoom out. Okay. I'll consider it coming back whenever we get back to, like, I don't know, negative 20, which might happen during the call. I don't know if I should just take a little teaser. Oh man, my head shakes. I believe in Jeff Green, but like, also, is this just becoming a mature business that grows at a regular rate of, high teens or 20% on breakout quarters, but has a 100 PE? That still sounds expensive. Now, after a 30% drop, it won't be that tomorrow. I mean, they did make more quarter over quarter and saw a 30% sell-off. So the multiple tomorrow will be a lot different. It'll probably be closer to like 60 times, but still, got to check that out. MP Materials up 8.4%. This is a name that I know nothing about, but still, like, kind of want to position in because I just think it's going to be like a strategic asset for the United States. So I foresee them probably doing well for a very long time. Pinterest down 8.6%. That's a completely uneducated point of view, by the way. Completely. It's my 30,000 foot view. Yeah. What are you guys doing with the trade desk here? Hey, Tanner, is there still possibility Hood is in the S&P? Yes, absolutely. There's still a chance. Soundhound up 7% right now. Yeah, I wouldn't be freaked out too much. If you guys are a believer in this business, you want large beats on revenue, not necessarily too worried about EPS at the moment. You're here to take market share, right? You can change costs after you have partnerships with every single business that you're dealing with. Block up 10, trade desk down 27. Don't know. Okay, let's continue to take a look at Chime really quick, because this is super interesting. Outlook, Chime down nearly 9. I knew whenever they went public, I was like, guys, people do not realize how good SoFi is. And then Chime comes out and everyone's like, whoa, let's pull this freaking IPO up. It's like, what are you guys talking about? This doesn't look anything like SoFi. They came public to show people how good SoFi actually is, how good Robinhood actually is. Buying really quality fintech businesses. Purchase volume grew 18% year over year. Week. No, I'm kidding. I'm kidding. I'm going to be so cruel to this business. I'm still going to listen. I've got a lot to learn, but yeah. Active members grew 23% year over year to 8.7 million. Average revenue per active member grew 12%. Outlook. Revenue between 525 to 535 million, resulting in a year-over-year growth of 24 to 27%. That's the same amount of revenue that you did this quarter. And adjusted EBITDA of 12 to 17 million. How much did you do this quarter? You did 16 million. So your third quarter guidance is your Q2 results with an adjusted EBITDA margin of 2 to 3%. Okay. Can't wait to listen to that. That'll be at 6 o'clock. But we can listen to the trade desk first. I'm actually very happy that we get to listen to both calls because I'm very interested in the trade desk. 26% now, maybe starting to do a little recovery here. Maybe I nibble a bit. Maybe. Do we really think that the stock is going to end up falling like, 35, 40%, like even as the call is going on? Like, I don't imagine we're going to see the largest sell off. But there is a definite position to be said about buying a company that just simply is not doing what the other ad names are doing. Sezzle is down. Sezzle down 19%. One of the highest flying names in the fintech industry. If you guys look, this is the last year. This is a 1-year chart. They're up 800%. At one point, they were up 1,000. I'm not going to buy a lot of shares of TTD, but a few. Maybe. Is this a bad idea? Is it an overreaction? They essentially did beat on all metrics, just not very strong. Just not, and then Q3 guidance that they ended up putting out was definitely where people are struggling here. Probably a bad idea. Yeah. I mean, that could be true. But you know what? It did work out for me for apps, so I don't know. Maybe whatever money I put in, I guarantee to sell tomorrow just for a 20% swing or something. What have I become? What have I become? Okay. Sorry, buying some TTD, and we'll buy again if it falls down to 30 again. Because at least I see that the market does see some sort of bottom and will buy this up. And they're not just like evacuating. Okay. Soundhound? Yeah, I know, right? Very exciting. Guys, by the way, call is going to start in the next 20 or so minutes, 22 minutes. Sezzle down 21% now. Pinterest down 10. Block up 10. The trade desk down 26. Expedia up 13.8. MP Materials up 8. That's all very exciting. Instacart up 7, but that swung pretty hard there. That's insane. At one point they were up 26%. Now they're up 7. That's pretty strong. StoneCo up 4. Abcelera up 17. Whoever got me Abcelera for the community fund, I think that's our biggest winner. And now it's up another 17%. Abcelera, $1.2 billion company. Pretty interesting name. I'd never buy it for my own portfolio simply because I do not buy anything in the bio space, but that is interesting. I like companies that continue to beat, that's for sure. TTD dropped on weak Q3 guidance. That's my assumption for sure. Yeah. Yeah. Q3 guidance was definitely not what I expected it to be. Oh, did we add stem? Sorry, stem. Flat. Okay. Well, not even worth it. Let's see if we can get a post for Pinterest here. I don't know if we covered their results just yet. Let's see. Okay. Sorry, was Twilio also down 12? They seem to have double beat. EPS expected at 104. They got 119. Revenue, they expected at 1.19 billion. They got 1.23 billion. But it was guidance. Once again, it was guidance. Adjusted EPS for next quarter was expected at $1.14. They came in at expecting it at 103. So 114 to 103. That's a big change in Q3 guidance. Yet full year guidance, like full year 2025, ended up getting raised. Expectation from Wall Street was 865 million, and I mean, it's kind of there. It's kind of in the 800. It's about 867. So slight beats for Twilio as well. But overall, if the trade desk wasn't down this freaking much, I think we'd have a party. Earnings overall has been very exciting. And I am a happy camper. The only thing that cannot blow up is Nvidia. Nvidia needs to do well, and then we've had an insane season. Insane. That justifies a premium. That justifies bringing up the S&P. I'm very happy SoFi investor still. Happy Shopify shareholder. But this is why we start small positions on new names. You know, a little bit of invest, then investigate. If Trade Desk wants to sell off, we buy the dip, and then if they continue to do bad, then it's not for us. That could very well be the case. Also, Serve Robotics was today. Serve Robotics down nearly 11. EPS missed by roughly 64%. Revenue, if you can call it revenue, beat by 3%, 642,000. There are people in chat that made more than Serve Robotics this year. A couple traders out there easily clearing what Serve Robotics is doing as an entire business. It's not too late to go public, ladies and gentlemen. Take yourselves public. Maybe you'll get a $600 million market cap for $640,000 worth of revenue. SMR ended up missing on revenue by 31%, but yet revenue is still up 738% year over year. That's crazy. And I bet you they're not even down all that much. 3.5%. TripAdvisor up 4%. Accelera up 17%. Stoneco up 4%. Texas Roadhouse starting to recover a little bit. Not down 4% anymore. Only down 2%. Monster Beverage. Wow. Pulling. The swings on these earnings are insane. Instacart, I think, had the biggest one, being up like 26, 27%, and now being only up 10. Still happy for a tenner, but come on. Come on now. Pinterest down 12, Sezzle down 29. Please, Sezzle, be worse than the Trade Desk. Let balance be restored. Earnings starts in 16 minutes. Will do. Will do. I don't have Sezzle numbers. We can go searching for them. Let's see if we can find what Sezzleo did here. No, I don't. Wall Street was expecting 94.9 million for Sezzle and 58 cents of EPS. I'm going to have to check directly on their IR. So let's give it a sec. I don't know if they have it out just yet. Oh, sorry. Yes, they do. What did I say we were expecting? 94 million expected for Q2. And they got 98.7 million. So that was a beat. And then EPS of 58 cents. I'm concerned that there's going to be a massive miss here. EPS. Earnings per diluted share was, no, that's for next quarter. 78 cents. That's looks like a double beat to me. There must be something else in the report, but honestly, I don't know the company well enough to cover it. So let's go through Chime's presentation here, because this is the first time we've ever seen a slide deck from Chime. We can see if there's anything that we like from the business before we listen to the trade desk here in a little bit. And then, where is Chime? I just saw it. Down 3% now, recovering just so ever slightly. And boom. Our mission: to unite everyday people to unlock their financial progress. All right. We drove rapid Q2 growth and operating leverage fueled by strong unit economics, with our outlook exceeding prior internal expectations. They saw asset-light business model driving attractive 37% year-over-year revenue growth, an 18 two-year adjusted EBITDA margin expansion of 18 percentage points. Strong unit economics. I mean, yep, that's good. 8x expected LTV to CAC. Yeah, that's big. Penetrated less than 1% of the massive market opportunity of 400 billion. I'd love to see how that's broken out. Grew active members by 32%, or sorry, 23%. By the way, the Chime turned green here in the after hours. Continued breakout of MyPay success. Launched our Gen AI voice bot. Achieved another Chime Core milestone, migrating all new debit and saving accounts to Chime Core, our proprietary payments processor and ledger, which actually is the reason that Galileo ended up having shrinking growth, was that Chime left. Purchase volume up 18, average revenue per active member went up 12, which is not the greatest sign, but I get that. What you would like to see is that average revenue is climbing faster than the active member growth, or purchase volumes growing faster than active member growth. But I get it. Back negative again, down 1% in the after hours. Transaction profit margin is 69%, up 21% year over year. Q1 benefit from tax refund related seasonality. Oh, people use them for just for that. Okay. 8.7 million. Not quite the same chart as what you'd see from a SoFi. Purchase volume, also not what you would see from a SoFi. That's for dang sure. SoFi has no seasonality here. Their chart looks up and to the right. There's no bounces in Q4 spend. I mean, this is making me even more bullish on SoFi. If this stock gets a premium, I demand a SoFi premium. I demand it. These are slow rates of growth. It's choppy. I don't like this. Just at first glance. Just at first glance. Non-GAAP OPEX as a percentage of revenue, though, I mean, that looks exciting. That does look exciting. Improved by 11 percentage points year over year and leverage across each expense category. Okay, that's cool. That's good. Where's S&M? 27%. Okay. And what color is T&D? 15%. All right. Adjusted EBITDA margin, 3%. Yeah, they said it was going to be the same next quarter as well. Yeah, Q3 EBITDA margin of 2 to 3% and full year margin of 4%. SoFi's is going to be what, 30? We're built different, okay? We are built different. Do I have to say it? I'm not impressed. This makes me excited. Talk about a comp. I'm going to make a video on this. Okay, estimated LTV to CAC, average revenue per active member, the transaction margin, active member churn in second year and thereafter of 10%, lifetime value of $1,813, and a customer acquisition cost of $109. That's good. Yeah. No, I mean, eight times LTV to CAC is insane. That's a very good rate. Like really, really good SaaS companies, you look and they will show you 3 to 5 times. Okay. Meaning that how much money you put in do you get out on the other side? Almost looking at like return on invested capital type thing. And an 8 times is very, very good. But I mean, I'm going to have to hear from the management to try to swing me here. If did I see 50% member churn in the first year? Is that what it said? Active member churn in first year, 50%. You're right. You're right. The problem with Chime's business is that you kind of help customers grow out of your product. Like you come in, you say, hey, we're going to fix your credit. Okay, you fix their credit. Why are you still on Chime? They have no products for you. That's sort of the problem that I have with Chime is like, there's no stickiness. People, whenever they're done with Chime, come to SoFi. Now, there is something to be said about whenever people get onto SoFi for SoFi Invest, they grow up and they grow out to Robinhood and brokerages that are bigger. But on the banking side, they dominate there. And you can see that from the types of products that companies put out, right? They try to match the products to the type of customer that they're attracting, right? So SoFi has like $3 million of where is the trade where's Trade Desk now? 27. Okay. It's roughly where we bought. Okay, what's it called? So if you show off to your members, oh, we're getting $3 million of FDIC insurance and I don't know what else, but benefits on home loans and these sort of things and credit cards that require high FICO scores, stuff like this, then that's the type of member that you're going to attract. Chime is not offering you any benefits on FDIC insurance, and they don't raise it from 2.5 million to 3 million because who the heck cares about 2.5 million to $3 million in FDIC insurance if you only have a few grand. So that's the type of customer that SoFi is attracting, is the people that need the difference of 2.5 and $3 million of FDIC insurance. Trade Desk, is it a sell? I just bought a little teaser bit more in the after hours. I think that this deserves to be down. Okay, it did not look good. But whether that's down 11% or 20%, something like 10 to 20%, I think that that's justified. The more than that, I mean, this seems severe. Chime is great for people with bad credit, unable to keep a minimum balance, and people who have felonies related to bank fraud. I mean, legitimately, I know that sounds extreme, but they literally do. That is true. They have products called Second Chance Banking, which is like actively for people who have messed up and are trying to recover, and a lot of credit building products. Now let's get ready for the Trade Desk. Remember, we're listening to both Trade Desk and Chime today. I'll chapter them as well, so you guys don't have to stick around if you don't want to. But if you're interested in both, and maybe we just listen to the first parts of the thing, like I don't know. This is the way I think about it. If you guys are interested in Amazon, in Facebook, in AppLovin, in any advertising space, and that could be Roku to Pinterest to Reddit, whatever. The Trade Desk is such an unbelievable business to hear about the space of advertising in the open market, in the open internet, I should say. Meaning not walled off gardens, meaning New York Post, Reuters, stuff like this, where there are advertisements, but it's not necessarily owned by one large conglomerate like a Facebook or a Google. Okay. But it will be very interesting to hear what he has to say. I just hope the spirit of the call is not just absolutely shot down, because I mean, they will look at the stock and see it's down 27%. And you know, Jeff Green has seen this stock at $140 to look back and see it at 64. I mean, that is a different picture. Anyway, I'm here to hear about the space of advertising. Hopefully some good news about migrating customers over to Kokai, and they're still on point with that, and that's going to get done by the end of the year, and that's going to boost revenues faster than expected or something into 2026. If he can say anything along those lines, like, yeah, Q3 is a little bit slower than what we'd anticipate, but we actually are extending our long-term guidance, that could turn it around pretty quickly. If he says something along the lines of, you know what, it's not going to be the end of 2025 that we migrate, but maybe second half of 2026 or first half of 2026, the stock's going to sell off even more. So that's what we're sort of trying to focus on here. Call starts in 2 minutes and 10 seconds. SoFi's 10Q is available now. I haven't even got my dang report out yet, and they're already putting out 10Qs. Damn. Okay. I just need a day where there's not the most unbelievable amount of earnings coming out. I'm going to be live from, 3:45 or whatever it was to 7 o'clock. And then I go live again after this to talk about other companies. I just don't have time for SoFi to be putting out a 10Q right now. Why is Soundhound flying? Soundhound is flying up 12%. Congrats. Sezzle down 25, Twilio down 15, Block up 10, the Trade Desk down 27, JFrog up 14.6, Expedia up 16.6, MP Materials up 6.8, Instacart up 8.3%, Accelera up 12%, Stoneco up 5%. It's a decent day. Earnings are definitely exciting right now, but Trade Desk kind of took the wind out of my sails a little bit. Starting the call here in 40 seconds. SoFi doesn't love you like we do. Yeah, I think they want to put it out when I'm live. But okay, let's get this ready. Let's hope for the audio. Oh, actually, you know what I'm going to do? Oh, ladies and gentlemen, we're going to do Earnings Hub again for this, just because listening to it and being able to see the stock price at the same time, I'm sure you guys will respect that. So that's what we will do. Yes. Okay, I'm going to do that instead. And then we will be able to look at the stock price. Oh, that's just perfect. Okay. Amazing, ladies and gentlemen. Okay, the call is about to start. I'm still listening to music. I'm live on the call. So don't worry. I'll throw it up whenever I get it here. And the music is quieting down. Okay, let's switch over.
Welcome to the Trade Desk second quarter 2025 earnings conference call. At this time, all participants are in a listen-only mode.
Okay, one sec.
Question and answer session will conference. Please press *0 on your telephone keypad.
Sometimes it duplicates.
This conference is being recorded. I will now turn the conference over to your host, Chris Toth. You may begin.
Thank you, operator. Hello and good afternoon to everyone. Welcome to the Trade Desk second quarter 2025 earnings conference call. On the call today are CEO and co-founder Jeff Green and Chief Financial Officer Laura Schenkein. A copy of our earnings press release is available on our website in the Investor Relations section at thetradedesk.com. Please note that aside from historical information, today's discussion and our responses during the Q&A may include forward-looking statements. These statements are subject to risks and uncertainties and reflect our views and assumptions as of the date such statements are made. Actual results may vary significantly, and we expressly disclaim any obligations to update the forward-looking statements made today. If any of our beliefs or assumptions prove incorrect, actual financial results could differ materially from our projections or those implied by these forward-looking statements. For a detailed discussion of risks, including the most recent economic volatility caused by...
If I could just say really quick, Earnings Hub has become so laggy, it's unbelievable, but we're good now.
Thanks. In addition to our GAAP financial results, we present supplemental non-GAAP financial data. A reconciliation of the GAAP to non-GAAP measures is available in our earnings press release. We believe that presenting these non-GAAP measures alongside our GAAP results offers a more comprehensive view of the company's operational performance. With that, I will now turn the call over to CEO and co-founder Jeff Green. Jeff?
Thanks, Chris, and good afternoon, everyone. Thank you for joining us today. As you've seen from our press release, we again posted strong growth in the second quarter. Our revenue grew about 19% compared with Q2 last year, and we continue to outpace the digital advertising market, driven by the innovation and value we deliver to our clients every day. CTV continues to be our fastest growing channel with no signs of slowing down. Partners like Disney, NBCU, Walmart, Roku, LG, Netflix, and many others are deepening their relationships with us around the growing decision programmatic opportunity in CTV, which delivers the most effective and highest return on ad spend compared to insertion order or programmatic guaranteed buying. I could not be more excited about our position in CTV and the size of the growth opportunity for us in the years ahead. With our leadership in CTV, as well as other areas such as retail media, digital audio, identity, measurement, and data, we are winning more business with both new and existing customers. We are signing more multi-year JBPs or joint business plans than ever before with leading agencies and brands. In fact, the number of live JBPs is at an all-time high, and we continue to see spend under JBPs significantly outpace the rest of our business. What's even more encouraging is the strength of our JBP pipeline with nearly 100 JBPs in progress, many of them in the late stages of development. And while many of our JBPs are signed directly with brands, we are working hand in hand with their agencies, almost in every case, to bring these partnerships to life. It is not an either or. I want to start by giving you an update on our business, but I also want to take the time to describe our vision and where we're heading. We see clearly what is on the horizon for our space, and we're convinced we're the best positioned company in ad tech to accelerate our growth in 2026. But it is important we share the opportunity we see because we think aligning our vision and efforts with our team, our clients, our partners, and our investors will maximize our ability to capture the unprecedented and unique opportunity in front of us. So first, an update on the business. There are several key areas of progress to highlight here. First, we are delivering on Kokai, our most significant platform upgrade to date, and one that represents a new frontier in digital advertising trading. Kokai gives advertisers unprecedented power to drive precision and relevance in everything they do, all powered by the industry's most advanced AI technology, Koa. We have injected AI into so many parts of the system that clients that have adopted Kokai have seen tremendous performance improvements. Samsung was able to drive a 43% improvement in reaching its target audience for an omnichannel campaign in Europe. Cash Rewards saw a 73% improvement in cost per acquisition for campaigns in Asia using Kokai. In the aggregate, we are seeing more than a 20-point improvement across key KPIs for campaigns running in Kokai. What's even more encouraging is that clients who have transitioned the majority of their spend on Kokai are increasing their overall spend on the trade desk by more than 20% faster than those who have not. This is precisely what we believed was possible when we launched Kokai. Advertisers are getting meaningfully better returns on their ad dollars, and they are doubling down on the open internet and on us as a result. Around 3/4 of all client spend is now running through Kokai, and we expect all of our clients to be using Kokai by the end of this year. Second, we are trying to create the most efficient supply chain possible for digital advertising, and we are seeing great progress with OpenPath. OpenPath allows publishers to directly integrate with the trade desk if they choose to, and it enables publishers to see more clearly how much our clients are willing to pay for their ad impressions. And it gives our clients a direct line of sight into what they are buying. And today, a material amount of spend on our platform is now flowing through OpenPath, and it is doing exactly what we expected. OpenPath is both a canary in the coal mine and a stalking horse. We don't expect 100% of spend to flow through OpenPath, but we do expect it to, one way or another, make the supply chain better and more efficient. And the benefits have been exceptional, not just for our clients, but for the publishers too. By providing our clients with clearer signal, they have more confidence in what they're buying, and they're typically willing to buy more. We have a long-standing partnership with News Corp, for example, and the New York Post has been one of the pioneers of OpenPath, and they've seen a 97% boost in their programmatic display revenue as a result. Also in the journalism field, Hearst newspapers have adopted OpenPath and have seen a 4x improvement in their fill rate since deploying it. As Amanda Gomez, SVP of Revenue Operations and Ad Technology at the New York Post said, and I quote, "The New York Post is always striving for ways to simplify our connection to advertisers to help fill our ad spots more efficiently and transparently. We partnered with the Trade Desk to test OpenPath to help achieve this goal with great success over the past year, ultimately helping to fuel programmatic revenue growth." OpenPath is not an attempt by the Trade Desk to get into the supply side of digital advertising. We're not getting into the yield management business. Our clients are exclusively the buyers. OpenPath is simply an effort to improve the quality of the supply chain for everyone in the ecosystem. Key to our supply chain work is our Sincera acquisition earlier this year. We have already made a tremendous amount of supply chain data available to the ecosystem for free via Open Sincera. There, anyone can log in and see the quality of advertising on thousands of publisher sites. Since launching Open Sincera just a few weeks ago, we've already had many publishers contact us to say they didn't realize some of the quality dynamics of the ad experience on their own destinations, and they are improving those ad experiences as a result. But as important as Open Sincera is, I'm even more excited to embed the full scope of Sincera data across our platform as one of the most important metadata sources and signals for the way that we value individual impressions and work on behalf of the buyers. For instance, we might see the same ad impression from hundreds of supply paths. We don't want to burden our clients with figuring out which one is best, and it is not efficient to manage that challenge by defaulting to deals. Instead, Kokai does that work for our clients, leveraging AI and data from sources like Sincera, so advertisers can obsess about buying the right impression rather than the delivery mechanism. But I do want to talk about deals for a second. One additional innovation that will help accelerate our supply chain work is Deal Desk. It is one of the major final pieces of Kokai, and it is in beta now. Deal Desk leverages AI, especially AI forecasting, to reshape how we think about deals between advertisers and publishers and intermediaries such as SSPs. It helps advertisers and publishers understand how deals are performing, how they are pacing, whether the right impressions are being delivered, and so on. But perhaps just as important, when deals are underperforming, Deal Desk will help those deals get back on track, and it will showcase open market and premium internet alternatives. We are seeing very strong appetite for Deal Desk across both advertisers and publishers. Everyone recognizes the limitation of deals and wants innovation that can help improve them. Disney is one of the first publishers to lean into Deal Desk. Jamie Power at the Walt Disney Company has said several times over the past couple of years that they intend to shift 75% of their ad revenue to biddable programmatic by 2027. I'm thrilled that our innovation will help them achieve this goal. And she said, when talking about Deal Desk, and I quote, "As more buyers shift toward biddable activation, we're focused on ensuring they have the tools, access, and flexibility they need to drive results. Our relationship with the Trade Desk reflects our commitment to meeting advertisers where they are and evolving how we transact to deliver greater efficiency and performance," close quote. The third area I'd like to focus on is work we've been doing to advance objectivity in everything we do and across the ad tech ecosystem. If the Google antitrust trial taught us one thing, it's that big tech walled garden advertising platforms have a vested interest in guiding spend to their owned and operated media. So with Google, it's YouTube. With Amazon, it's Prime Video. And of course, they can make it seem really cheap from a platform perspective because they make up that cost and much more on the other side of the transaction because they own the media. But if you want to reach your audience with objectivity and with no thumb on the scale across the best of the internet, you're more likely to come to the Trade Desk. We're seeing more and more clients understand the importance of objectivity and the power of the premium open internet to reach their target audience as precisely and cost efficiently as possible. Live sports is a great case study. It's where advertisers get to act with precision and objectivity in reaching their audience where they are most engaged. A few years ago, just after the pandemic, I was on an industry panel in New York City where many of my peers on stage made the argument that live sports would be the linchpin that keeps viewers on linear TV for years to come. I think many of you may have even been at that event. If you fast forward through the impact of a global pandemic, now all live sports are available via streaming TV and represent one of the most valuable pillars of the open internet. And we continue to innovate with our partners to bring the full value of live sports to our clients. One of the promises of live sports in a biddable CTV environment is that advertisers can target key moments like overtime in an NBA game or the PKs at the end of a soccer game, when the audience is most leaned in. Well, now we will be offering this capability with new tooling in Kokai and partnerships with companies such as Disney, Sky TV, and Omnicom, which we announced at Cannes a few weeks ago. Another major pillar of objectivity on the open internet is the ability to measure business outcomes of marketing campaigns with precision. Kokai already has the industry's most advanced retail media marketplace, but we've recently launched expanded partnerships with leaders such as Instacart and Ocado to provide even more granular data on actual consumer purchases so advertisers can measure with even greater precision. Again, objectivity is a major factor here. Unlike others in the market, Our goal is to drive the use of retail data across as many advertiser campaigns as possible. We do not compete with retailers, and only an independent, objective partner like us can truly help advertisers unlock this opportunity. In Q2, a record amount of spend was influenced by retail data, both on our platform and on the Walmart DSP, as more shopper marketing budgets flow into programmatic. And fourth, I'd just like to reiterate that underpinning all of our success this year is a strong focus on operational rigor. This includes strengthening our leadership team. As you know, Vivek Kundra joined us as our COO in March. I'm also pleased to announce here that Alex Kayyel will be joining as our new CFO. You may know Alex as he's on our board, but his relationship with this company spans over a decade, initially as an early investor in 2014. He's also been a leader in the digital space for more than 2 decades. I'm thrilled that he's agreed to join our leadership team, as I believe there are few in our industry who have Alex's experience and strategic mindset in finance in a way that incents and drives growth for the organization. This shift has been made possible by Laura working with Alex to facilitate this transition. She will remain in the seat until August 21st and then stay on the team through the end of the year. I have worked with Laura for more than a decade, and I have nothing but tremendous respect and admiration for her work and her expertise. We wouldn't be here without her contribution to this point. Laura's contribution and passion will live in the trade desk for the entire future of its existence. I love that we joined the S&P 500 during her last full quarter. What a milestone, and what a note to end on. We are also enhancing the board of directors, and I couldn't be more excited to announce that Omar Tawakkol will also be joining the board. Over the years, Omar has been one of the real innovators in ad tech, whether it was founding BlueKai in 2007 or more recently founding Rembrandt, one of the leaders in creative AI in advertising. I look forward to his innovator's vision as a part of our board work. In addition to strengthening our leadership team, we have improved the structure and clarity of our go-to-market organization, particularly in how our media traders, account management, and business development teams work together. This ensures that our clients experience the full power of our platform with clear roles and responsibilities across our teams. Lastly, I think this is a unique and important moment to remind our investors, our clients, our partners, and the rest of our industry about our mission, our vision, and our collective opportunity. Global advertising is a trillion-dollar industry today, and that TAM is all up for grabs. Additionally, AI is changing everything and creating new opportunities. Quality AI requires quality data, and to trust AI-driven buying long-term requires objectivity. A black box that just sells owned and operated media will struggle far beyond what ad networks have struggled with for decades. Our vision is to define clearly the category of a DSP. Access is not at the core of our value proposition, simply getting access to inventory. Database decisioning and measurement is at the core of our offering. Some have mistakenly thought our ambitions are about display. Some have mistakenly thought our ambitions were only about CTV or branding budgets. Our goal is to buy the entire open internet objectively for buyers, big and small. We've started with the biggest, and we serve them well. We think we've done the best job in the history of ad tech of aligning our interests with buyers. This enables them to trust us with their data. But on that topic, one of the biggest flaws with walled gardens is that they measure their own performance. We believe it is in the best interest of every retailer, including Amazon, to have the measurement of the open internet based on something more auditable, more independent, and more transparent than what happens today. We've partnered already with hundreds of retailers around the world to measure in this more objective way. Our retail partnerships play a very significant role in making it so that the premium open internet gets the first dollar of budget and not the last dollar. There are a tremendous number of inefficiencies in the open internet supply chains for both media and data, and we have big plans to change those. AI is currently changing the world. It is also changing the world of advertising and media buying. There are so many specific tasks where AI can massively level up the status quo. What is an impression worth to a specific brand? What is the price that this auction is likely to clear at? What is the best supply chain to maximize transparency and minimize unnecessary costs? These applications of AI are already in our product. COA is what powers Kokai forecasting, which is predicting the reach and performance of a campaign before a single dollar is spent. Distributed AI is foundational in Kokai, and this is only the beginning. There are many tasks where agents can improve performance in part because they're always on. As you consider the power of AI in these specific applications, you can see how winning the trust of buyers is so critical. It is a buyer's market, and as a result, premium inventory matters more than ever. Again, our value add isn't that we merely have access to the best of the internet, which is what we refer to as the big five. These big five are the best of TV, the best of movies, the best of music, the best of journalism, and the best of sports. Currently, consumers spend most of their time on these big five, but most of the money goes to search and social. It is our aim to make the open internet the lion's share of spend and the highest efficacy ad spend in digital. As I've said for over a decade, the lines between brand and performance are artificial and will go away over time. Everything is performance, but some performance is optimized for awareness and top of the funnel outcomes, and others are pointed at the bottom of the funnel outcomes. Nevertheless, everything that can be quantified will be, and most spend will be pointed at outcomes. Before I wrap up, I want to take a moment to speak to the proposed extension of our dual class share structure, which was included in our most recent proxy filing. There will be plenty of opportunities to engage in more detail in the weeks ahead, but I think it's important to provide some perspective now on why the board is making this recommendation. From the day the Trade Desk was founded, we believe that long-term thinking is our greatest advantage. The vision that we described is a long-term North Star that we think about in nearly every major decision we make. Dual class helps maintain that long-term North Star orientation. When we went public in 2016, we chose a dual class structure because we knew building something transformative, something that could truly redefine the open internet, would require conviction, patience, and freedom from the short-term pressures that weigh on public companies or are the one-size-fits-all approach often promoted by some governance analysts and major proxy advisory firms. Our belief has proven correct. Since then, we've grown from below a $1 billion market cap to about $40 billion today and included in the S&P 500. We've helped shape the future of identity with UID2, built leadership in CTV and retail media, expanded globally, and invested in innovations like Kokai, Sincera, and our TV operating system, all of which require decisions that didn't pay off in a quarter or even a year, but instead positioned us to lead for years to come. We're now at another inflection point. The digital advertising landscape is evolving rapidly, with ongoing regulatory scrutiny of walled gardens, the rise of AI, and growing demand for transparency and independence. We believe the next decade will be pivotal in determining the winners and losers in our space, and that staying true to our long-term vision is more important now than ever. This proposed extension isn't about entrenchment. It's about ensuring that the founder-led strategy that got us here can continue to guide us forward. We deeply value the trust our shareholders have placed in us, and we remain committed to earning it every day and for the long term. Let me wrap up by bringing some of these points together. We continue to earn a growing share of the total advertising pie. That momentum is a direct result of the innovation and execution we're delivering week in and week out, and the value our clients consistently realize by working with us. About 3/4 of our spend is using the Kokai platform. It is the best platform we have ever shipped, and we're confident it will buy better than every other platform pointed at the open internet. We have always prioritized helping brands find their target audience with precision and relevance across the breadth of the open internet. The Trade Desk empowers brands with the tools to control and own their own future. We do that by prioritizing objectivity in everything we do and with a relentless focus on driving a clean, transparent, and competitive marketplace. I believe it's these principles and the performance they ultimately drive that attract major brands to our platform. And it's our dedication to those principles that's keeping them here. All of this positions the Trade Desk to lead through what we believe will be another defining period of growth. We're building right now for this next chapter, not just for this year, but for the long-term future of the open internet. AI is yet another force separating the great platforms from the weak ones. We've proven time and again that our alignment with advertisers, our focus on innovation, and our commitment to transparency and objectivity sets us apart. And with the upgrades we've made across our company, our platform, and our partnership, I'm more confident than ever that the Trade Desk will continue to capture more than our fair share of this growing market. With that, I'll hand it over to Laura to walk through the financials.
Thank you, Jeff, for the kind words, and good afternoon, everyone. I've been at the Trade Desk since 2014, and I'm proud of what we've accomplished together, from our early days as a startup to going public to joining the S&P 500. It's been an honor to work alongside and as part of the leadership team. There were and are so many talented people across this company. I've also truly valued the relationships and conversations I've had with many of you in the investment community over the years. As I transition to a new challenge, I leave knowing the company is in a strong position for the future. Our finance and accounting teams are as capable and energized as ever, and I'm committed to supporting a smooth transition for Alex as he steps into the CFO role. I met Alex in 2014 when Hermes was one of the company's earliest investors. He is respected, and I have confidence in him as he takes on this new role. With that, let's move on to our results. We delivered a strong second quarter with revenue of $694 million, representing 19% year-over-year growth. Excluding political spend related to the U.S. elections last year, revenue increased around 20% year-over-year. During the quarter, we continued to build momentum across our key growth areas as advertisers increasingly value the efficiency and measurable results of their media investments. Growth was particularly strong within CTV and retail media, fueled by the continued shift into decision channels for buying TV and the rapid adoption of retail media across verticals and regions. With over 70% of spend now on Kokai, we continue to see strong results from the new platform. We look forward to completing the Kokai transition and continuing to innovate on behalf of the industry and our clients. With the strong top-line performance in Q2, we generated approximately $271 million in adjusted EBITDA, or about 39% of revenue. From a scale channel perspective, CTV led our growth again during the quarter. In Q2, video, which includes CTV, represented a high 40s% share of our business and continues to grow as a percentage of our mix. Mobile represented a mid-30s% share of spend during the quarter, while display represented a low double-digit share and audio represented around 5%. Geographically, North America represented about 86% of spend and international represented about 14% of spend for the quarter. We're pleased that international growth once again outpaced North America as we continue to execute our growth playbook globally, led by CTV. We remain optimistic that our business outside North America will continue to be a strong contributor to our overall growth throughout the remainder of this year and in the years to come. In terms of verticals that represent at least 1% of our spend, we saw double-digit growth in the majority of our verticals, with particularly strong growth in technology and computing and medical health. Home and garden and style and fashion were below average. We continue to see significant opportunities for us to gain share in all of the verticals we serve. Turning now to expenses. Q2 operating expenses, excluding stock-based compensation, were $448 million, up 23% from a year ago. During the quarter, we continued to make investments in our team and platform, particularly in areas like platform operations, as the AI and machine learning tools embedded in Kokai continue to drive greater campaign performance. Income tax expense was $43 million in the second quarter, driven primarily by our profitability and stock-based awards. Adjusted net income for the quarter was $203 million, or 41 cents per diluted share. Net cash provided by operating activities was $165 million, and free cash flow was $117 million in Q2. DSOs exiting the quarter were 91 days, up 1 day from a year ago. DPOs were 77 days, up 2 days from a year ago. We ended the quarter with a strong cash and liquidity position. Our balance sheet had about $1.7 billion in cash equivalents, and short-term investments at the end of the quarter. In Q2, we used $261 million of cash to repurchase our Class A common stock via our share repurchase program. Given our strong balance sheet and consistent cash flow generation, we plan to continue opportunistic share repurchases while also offsetting dilution from employee stock issuances. Turning to our outlook, assuming the macro environment remains stable and we don't see disruptions from large global brands, which make up a significant portion of our business due to tariff uncertainty, we expect Q3 revenue to be at least $717 million, reflecting 14% year-over-year growth. Excluding the benefit of U.S. political ad spend in Q3 of 2024, our estimated growth rate in Q3 of this year would be approximately 18% on a year-over-year basis. We estimate adjusted EBITDA for Q3 to be approximately $277 million. In closing, we are pleased with our strong performance in Q2 and throughout the first half of the year. The opportunity ahead has never been more compelling. We're operating in a large and expanding market, supported by a business model that consistently delivers strong top-line growth, solid profitability, and healthy cash flow. I remain confident and optimistic as we look to the second half of this year and beyond. That concludes our prepared remarks, and with that, operator, let's open up the call for questions.
Certainly. At this time, we will be conducting a question and answer session. If you would like to ask a question, please press *1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press *2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Once again, please press *1 if you have a question or a comment. The first question comes from Shyam Patil with SIG. Please proceed.
Hey guys. Hey Jeff. Congrats on another solid quarter. I just had one question. As we look into the back half of this year and into next year, what gives you the most confidence as you think about how the digital ad environment is evolving and how you're positioned to lead through it?
Thanks for the kind words first, Shyam, and appreciate the question. Honestly, I have never been more excited about the position we're in as we head into the second half of the year, but especially as we look into 2026. From a macro standpoint, some of the world's largest brands are absolutely facing pressure and some amounts of uncertainty. Some have to respond more than others to tariffs. Many are managing inflation worries and the related pricing that comes with that. And there are a number of macro issues that I hear about. But to me, all of these themes can be brought back to a few themes. The first being that uncertainty is an opportunity for us to grab land. Second, everything in programmatic is measurable. It's agile, it's transparent, and it delivers results. Third, advertisers are more performance-driven and deliberate with their spend than ever before, and that plays directly into our strengths. Fourth, and this one goes unsaid way too much in trade press, and I don't believe it's fully acknowledged in all of the industry press as well as things that are even peripheral to that, and that is that the supply-demand imbalance is more in our favor than it has ever been before. Fifth, and we have understated this to date, but I believe that we talk about this a lot more in our prepared remarks this time. We sit on top of one of the most underappreciated data assets on the internet, and frankly, in the world. And given that we do in 30 seconds as many transactions as Visa and MasterCard do in a year, if you add them together, and that quality data is now feeding an AI engine that helps the biggest buyers in the world sort out the most complex supply chain they've ever faced in advertising, that means our data plus AI creates an amazing opportunity for us, for the open internet, and for the biggest brands in the world. And then sixth, which is somewhat related to that supply and demand imbalance that I mentioned, consumers spend more of their time in the premium open internet than they do inside of walled gardens. And premium advertising performs better. and yet more ad spend goes to walled gardens. To me, this represents a huge opportunity. As one employee said recently who joined our company, something to the effect of, I joined Trade Desk from Facebook because I believe TTD and the open internet have a bigger TAM than Facebook has, and obviously a lot more unrealized upside. And I believe all of that stuff put together is the reason why we continue to take share. You can see that in the CTV upfront this year. Many advertisers, you could even say most advertisers, prioritize flexibility over full year commitments. And that is a benefit to us and to the open internet. CTV remains our biggest opportunity, and we continue to see amazing momentum in CTV. But we're also seeing great traction in retail media, and our joint business plans have more JBPs under negotiation than we've ever had before. And the spend within those JBPs are actually growing significantly faster than the overall spend on our platform. As you know, internally, we're leveling up, not just in our product, but across the company, people, process, product, systems, and the coordination between product and engineering has been improved dramatically, and that's accelerating the innovation and product velocity to unprecedented levels. We expect all clients to be using Kokai by the end of the year, and Deal Desk continues to gain traction. With Vivek joining as our COO, we're also doubling down on operational rigor by strengthening senior leadership and improving go-to-market discipline. On the supply chain, we're driving efficiency across the ecosystem with innovations like OpenPath and our integration of Sincera. As Google continues to pull away from the open internet, that creates a vacuum which we're stepping into. Stepping back, it's more of a buyer's market than it's ever been before. Large publishers need partners like the Trade Desk to win. And as Google and Facebook have largely abandoned the open internet, the Trade Desk is the largest source of third-party demand for many publishers around the world. So there is some uncertainty out there for some large brands, but when I look at the trends, the products, some of which we've shared publicly, but some of which we have not, our partnerships, our pipeline, and our leadership team, I could not be more excited about where we're headed as we close out this year, and especially as we look ahead to 2026.
Thanks, Sean.
Okay, the next question comes from Vasily Karasyov. Please proceed.
You're up, Vasily.
Vasily, your line is live. Vasily seems to be having technical difficulties.
Yep, let's just go to the next caller.
Okay, the next question comes from Youssef Squali with Truist Securities. Please proceed.
All right, thank you so much. And Laura, thank you for all the help over the years, and best of luck in your future endeavor. Jeff, I have a question for you. So there's been growing investor and media focus lately on Amazon's advertising efforts, particularly with DSP and Prime Video ad inventory. From your vantage point, how are you evaluating the evolving competitive landscape? And I guess more specifically, have there been any meaningful changes in how Amazon is showing up competitively in the market?
Yeah, thanks for the question. Honestly, I was hoping somebody would ask this question because it's perhaps one of them that I'm most excited to talk about. So first and foremost, our strategy has not changed. We give marketers the power and the tools to own and control their own future. And we want them to do that with, of course, the things that have gotten us here, which is full transparency, objectivity, and access to the entire internet. In my opinion, that is the only way to get large clients to come on your platform and stay there for the long term. And that's why it's always been our focus. And it's why we've constantly and consistently won the trust of the world's largest brands. We have long said that walled gardens, whether it's Amazon or Google, are best suited to buy their own inventory with their own data. But their bias makes it hard for them to buy across the open internet in a truly objective way. So when you look at it from that perspective, or from a certain perspective, point of view, Amazon is not a competitor, and Google really isn't much of a competitor anymore either. We're trying to buy the open internet leveraging technology that values media objectively. We don't have any media, and we don't grade our own homework. In my opinion, and to me, all the data suggests that we're right on this, despite their mixed messages, they are not trying to buy the open internet objectively. They can't. They have way too much Prime Video supply to sell to ever honestly pitch large brands to objectively buy the open internet. They push sponsored listings most and Prime Video after that. Neither of those compete with us, which is why I say that we're not really trying to compete with Amazon. When they argue that their DSP, which is not even their top advertising priority, let alone the core of their business, when they argue that that's objective to the biggest advertisers in the world, I believe they weaken the rest of their advertising pitch and they weaken the strength of their AWS pitch. A scaled independent DSP like the Trade Desk becomes essential as we help advertisers buy across everything. And that we have to do that without conflict and without compromise. It is my understanding that Amazon nearly doubled the supply of Prime Video inventory in the recent months. That creates a number of conflicts. And in my opinion, it further weakens their already shaky arguments about objectivity. But if that weren't enough, Amazon already competes with many of the world's biggest advertisers in categories like retail, CPG, and cloud, which makes it difficult for those brands to fully trust them as a partner. And when you add in concerns around trust, especially data trust with AWS, it becomes even more challenging for Amazon to credibly position itself as a neutral or even a higher bar, objective platform. We're already seeing the shift as major brands have been reallocating spend toward the Trade Desk for years, precisely because of our independence and objectivity. So to be clear, if you insist on calling Amazon a competitor, we compete with a tiny division of Amazon. We don't compete with Amazon.com or retail. We certainly don't compete with AWS. We compete with whatever small amount of spend goes to the Amazon DSP that isn't spent on Amazon owned and operated. I think Amazon is more of a potential partner, honestly, than it is a long-term competitor. If Amazon opens Prime Video to external demand, which I believe they should, we believe we'd be an amazing partner to drive demand to them, and it wouldn't surprise us if that were to eventually be the course that they choose to take. But to sum up, while we watch them closely and we know exactly what they're doing, we are playing in a very different sandbox. Ours is focused on decision media, precision, identity, and outcomes. They're still primarily focused on pre-negotiated deals that lack an open identity solution like UID2. None of their strategic decisions or investments suggest that they're trying to buy the open internet objectively, or even that that is a priority. I'm very optimistic about where we're headed, especially as the overall TAM continues to grow. I believe the bigger TAM of advertising will always be pointed at the open internet, and that's why we're focused on that. Thank you so much for the question.
Thank you, Jeff.
Next question is from Vasily Karasyov with Cannonball Research. Vasily, please proceed.
Hi, can you hear me now?
Yes. Welcome to the call.
Fine. Apologize for what happened before. Jeff, you work with nearly all of the world's biggest advertisers, and Laura in her prepared remarks mentioned the uncertainty because of the tariff situation, and we also heard names like P&G, Kimberly-Clark, Ford, Volkswagen talk about this uncertainty on their earnings calls. So my question is, how do you see that dynamic playing out in terms of ad spend in the remainder of the year, and how are you factoring that into your Q3 guidance? Would appreciate color on this. Thank you.
First of all, great question, and I also really appreciate just the framing in your question, because I think it exemplifies some of the pressures and some of the companies that are facing pressure. If we look at how the last year has progressed, Q4 was relatively stable, though you could see signs of volatility beneath the surface, particularly against the backdrop of what seems like a long time ago, but was a fairly contentious election cycle. That pressure intensified in Q1 with growing concerns among the largest brands and agencies, which of course make up the vast majority of our business. In Q2, starting right at the beginning of April, some of the biggest brands, particularly in sectors like auto and CPG, which are, of course, meaningful categories for us and for the Fortune 500, they began to experience even greater volatility. But since then, things have stabilized. I think it's important to know things are more business as usual. However, the impact of tariffs and related policies on these businesses are very real. And you've heard that in earnings calls if you listen at all. There is an important point that we haven't made enough, I think, in our prepared remarks, and I don't know that this is fully appreciated about the difference between us and many other businesses in digital advertising. Most others rely heavily on SMBs, and our platform is largely concentrated on the large global advertisers. So we see the effects that are directly impacting them. So I would argue that this is a short-term negative, which, by the way, this fact that we concentrate on the large ones is not generally a negative. It is almost always a positive, but just in this moment, it's negative because of how uniquely they're being affected by the tariffs and related policies. But the reason I am so bullish is that in volatile environments, these things have historically accelerated the move to programmatic precisely because it comes with control, agility, and performance. When advertisers become more deliberate and performance-driven, programmatic is at its very best. That's the very best that we can offer to them, and that's when we're doing our best work for them. So because programmatic, which really is just a fancy word for fast-paced and data-driven, is measurable, because it's measurable, it allows us to win share. So we also see some tailwinds that I think are important to point out. The number of joint business plans we have with major advertisers continues to increase, and the spend under those JBPs is growing significantly faster than the overall spend on our platform. Agility and flexibility matter more than ever. Objectivity matters more than ever. And that's been especially evident in the CTV upfronts, where many advertisers are opting for flexible commitments over the full year deals. And that shift continues to play into our strengths. So while I'm mindful that there are some macro backdrop and there is a lot of pressure on some of the biggest brands in the world, we are confident that our combination of programmatic and our position in the market puts us in the very best spot heading into the second half of this year and, of course, into 2026. So thank you so much for the question.
Thank you.
Up next is Justin Patterson with KeyBank. Please proceed.
Great, thank you. And best of luck to you, Laura, with the next steps. Jeff, could you please elaborate on the progress with Kokai, both from a product perspective and from the engineering changes you made late last year? And then related to that, can you also talk about the ROI you're seeing from some of these AI capabilities embedded across the platform, whether it's algorithms or some of those agentic use cases that might emerge over time? Thank you.
Thank you so much, Justin. Really appreciate the question. I mentioned that I was excited about the Amazon question because it's one of the things that I was most excited to talk about. The one that I was most hoping for, though, is honestly this question, because there is nothing that I'm more excited about in our business, both in the short term and in the long term, than I am all the products that we're shipping now, and especially the foundation that we've laid in Kokai for the innovation that can be built on top of it. So, that is largely connected to AI. And I am just so excited about what we're seeing already in the results that have come from AI and what that means for our future. Again, finally utilizing what I think has been one of the most underappreciated data assets on the entire internet. So first of all, the progress in the last few months has been amazing. The iteration on client feedback has been really rapid, and the releases, especially over the last month, have made Kokai truly the best ad tech platform ever pointed at the open internet. Kokai, of course, is the most significant platform upgrade in our company's history, and it really marks what I think is a new frontier in programmatic advertising, in part just because of the advent of AI and what's possible. We've injected AI into so many areas in our platform, like in forecasting, in campaign optimization, in supply path optimization, in predictive clearing, and in all of those places, it is already paying off. So to just give you a sense of some of the impact, clients who've adopted Kokai are already seeing dramatic performance improvements. Samsung saw a 43% increase in its ability to reach target audiences for an omnichannel campaign in Europe. Cash Rewards in Asia reported a 73% improvement in cost per acquisition. And across the board, Kokai campaigns are outperforming legacy ones by more than 20 points on KPIs. But even more telling are the clients who have shifted the majority of their spend to Kokai because they're increasing their total spend on the platform more than 20% faster than those who haven't. So those that lean in and try it, see results, and then they accelerate their businesses. Today, about 3/4 of spend is already flowing through Kokai. So the vast majority of our clients are already on it. And we expect full adoption of all of our clients. In other words, all of our clients will use it before the end of the year. And we're just getting started when it comes to AI. We've developed a system of distributed AI that comes with checks and balances, which allows innovation to happen in parallel from a number of different teams all at once, which makes me really excited about our pace of innovation. Honestly, there's not a single topic that I can talk about today that I am more excited about than our pace of innovation. But as we look ahead, we're building toward an even more AI-driven world, if you will, where there's agentic use cases, where intelligent agents can monitor, adjust, and optimize campaigns in a more effective and more real-time way. Like, one of the great advantages of AI is that it's always on. And of course, we look at doing this in a way that is a little bit different than others in the advertising space, where we're trying to do that in conjunction or in cooperation with agencies and those that buy from brands. Right now, I'm also extremely excited about Deal Desk, which we started rolling out this quarter. It's currently in beta and represents one of the final pieces of Kokai. It uses AI, especially in forecasting, to rethink how deals between advertisers, publishers, and the intermediaries between them could work or should work. Deal Desk can evaluate pacing, delivery, performance, really everything, and rescue underperforming deals by surfacing open market or premium alternatives. We're seeing strong interest, by the way, from both advertisers and publishers. And I'm especially excited that Disney is among the early adopters for this. I think that denotes an amazing vote of confidence, but it's also showing that the strain on deals is actually one of the biggest challenges facing the programmatic ecosystem today. Kokai is driving real performance gains, and the AI underneath it is powering both near-term results and long-term innovation. Our teams are shipping faster and more efficiently than ever, and because of that, I'm really excited about what that unlocks this year, and especially as we head into next year and continue to layer and innovate on top of what we've been building all year long. I'm really proud of what our engineering and product teams have done, and they have worked very hard this year, and I believe it's laid a foundation for a much brighter future for the Trade Desk. And I, along with all the other shareholders, am super grateful for their work. So thank you so much.
Thanks, Justin.
Next question comes from Mark Mahaney with Evercore. Please proceed.
Okay, thanks. I want to run by you two questions. First, you talked about this 20-point improvement across key KPIs for campaigns running in Kokai. Is there a snowball element to that? Is that something that you just go from 0 to 20, or is this something that builds over time? Like, talk about the cohortization or whatever, how long it takes to get to that 20-point improvement, and do you think it goes higher than that? And then, Laura, the one segment, the two segments you called out is underperforming, home and garden, style, and fashion. I think that's 10 to 15% of your revenue, something like that. Any color on why you think that segment may be underperforming? Thank you very much.
Yeah, absolutely. Mark, first, thanks for the question. And let me just open with the first part, and then I'll hand it off to Laura. So as it relates to the 20% improvement, let me answer the last part of your question first, which is that I believe that is merely scratching the surface of what is possible over time. So the unlock that AI can bring to campaign optimization is really just beginning. Whether that is slow or fast largely depends on how campaigns are constrained today. So while there is more supply than there is demand, there is often a bunch of settings on any individual campaign that make it so it really can't select from all the options that are the very best to help that perform. So essentially what we're creating is a dialogue between man and machine to make it easier for people to see what is constraining their campaign and what would be the unlock. It's not just simply give us your money and step away from the keyboard. The biggest advertisers in the world would never operate that way. So in order for us to help them own their future, we have to enable that dialogue, which is of course more complicated than just saying, give us your money and we'll take care of everything from there. So with that approach, sometimes the 20%, if you will, can be found immediately. And sometimes it just takes a little bit of ramp. It depends on how well they've optimized their campaigns to date in the somewhat manual way that many of them do so. But there are much more unlocks than just what we've seen so far. We just need to continue to engage with them. And it's very quickly becoming that the tools are not the bottleneck. That's what we've been working so hard to build. It's actually the understanding, the engagement, the feedback, the reporting, the new way of engaging, which takes some time to learn, that is increasingly the bottleneck to them realizing that 20% plus. The plus is the part to underline there. So thanks for the question. Laura, your response to the second part.
Yeah, hey Mark, thanks for the question. Of the categories that I mentioned, I believe the first of them was home and garden, and I would just say for home and garden, it's just more seasonal as summer moves on. That's only about around 8-ish% of the business. If I recall correctly, the second category I mentioned was style and fashion, which is about half of that, 4% of the business. There are just always some categories above the corporate rate and some below, and those were the two that I highlighted in the midst of the call.
Okay, thank you. And congrats, Laura, on a great track record, 34 out of 35. That's amazing. So congrats, wishing you all the best.
Thanks, Mark.
Thanks, Mark.
The next question is from Jessica Reif Ehrlich with Bank of America. Please proceed.
Thank you. Jeff, while you make a passionate argument for the open internet, it seems like it's losing share when you look at the growth rate of walled gardens, including Meta, Amazon, Google, these big companies. How do you envision the share shift, the way you describe it, how do you envision the share shift in walled gardens versus open internet over the next few years? I mean, or is it just that CTV and retail media are just growing slower than walled gardens? And for, I guess, Trade Desk specifically, you talk about taking share. Look, who are you taking share from? Is it other CSPs or is it from the walled gardens?
Thank you so much for the question. I'm really excited to answer this because I think you represent a lot of people in asking the question. And I think this is one of the most important, while I was excited to talk about Amazon, some of the other things, this might be the most important question for us to ask today or to answer today. So first of all, it is true that consumers spend more of their time on the premium open internet. And if you think about this from your own perspective, and I'll just speak for myself rather than everybody else, but I spend a lot of time inside of premium connected television. I spend a lot of time inside of Spotify and premium audio, and same with movies. And I grew up playing sports. I like watching sports a lot. When I think about that, and then you add journalism to that, I think about those big five that we described and the amount of time that's spent there, as well as where all the purchasing power is. And then I think about my interactions with YouTube, for instance, where I go there just like nearly everybody else does. But when I'm consuming content and there's ads there, I'm hovering over it to skip it. It's a very different engagement than I have with the rest. The premium open internet performs way better. It's way better for the biggest brands to be associated with it. So you can look at like the amazing performance that Facebook put up this quarter and say, well, aren't they gaining share? And I do think they're doing very well. And I do think they fully understand that of course, AI represents an opportunity to optimize. In some ways, they do have an easier assignment in that they have a nearly unlimited amount of supplies. People continue to spend time on Instagram, and they can optimize their supply chain and interact with SMBs and improve their margins. And I believe that those things together, because they're optimizing an ecosystem that they control, that is very good for them, and that's why they've done well in the short term. It is a much easier short-term assignment to inject AI into one destination or two destinations in Facebook and Instagram than it is to create better supply chains for the entire internet. And because we're doing that among the most premium parts of the open internet, it naturally takes a little bit longer, but it also comes with way more upside. So, and if you look at this long term, where do consumers spend most of their time? What is the content that they love the most? Where do those with purchasing power spend most of their time? And where is it best for the biggest brands in the world to affiliate? You get way more big brands in that big five, if you will, than you do in your scrolling on Instagram. And so as a result of that just very real phenomenon, I believe it's only a matter of time before the majority of spend is on the open internet and not inside of walled gardens. It's simply because they have an easier job. And also because they've taken the easy path, if you will, as it relates to measurement, which is it is easier to grade your own homework and not rely on anybody else to do so. But as we try to make it so that we're ensuring that we're actually selling and that we're in this for the long haul, it takes a lot more work to coordinate among hundreds or even thousands of companies to make the very best supply chain. But as great markets do, they always over time work out the inefficiencies. Those that navigate a somewhat convoluted supply chain to make it an efficient supply chain. I think of what Amazon has done in the retail business. And in a lot of ways, that's what we're trying to do to the media side of business. So that is a long haul, just like it has been for Amazon to do inside of retail. But they have changed everything by doing what they do well. And we are doing, I believe, the exact same thing to the media side of the open internet. So I really appreciate the question, because I'm not sure that there was a better way to give us a forum for why we believe we win long term. But I think it's really important to understand that we're playing a very different game and a long game. And that AI changes everything, and that does create a big advantage for us. But it's not as easy to realize in a quarter or two as it would be if we controlled the whole supply chain.
Thanks, Jessica. And John, we have time for one more.
Okay, the next question comes from Matt Swanson with RBC Capital Markets. Matt, please proceed.
Yeah, thank you so much for making time for me and taking this last question. Jeff, we've touched on it a lot. You guys obviously have an enviable position in the enterprise in terms of your customer base. But when we think about kind of like the usability of Kokai and then the established space of the SMB for performance dollars, and then kind of this emerging SMB market in CTV, does the usability and AI features of Kokai make that a more attractive market for you to go after over time?
Thank you very much for the question, because this is one thing that I don't think we were able to talk about enough in the prepared remarks. So especially in light of the question that I just answered, I think it's a very fitting sort of follow-on to that question. So we've been very clear with our strategy. And about 10 years ago when we went public, we made the decision to essentially just be open about some of the key components of our strategy. Honestly, I was a little reluctant to do that at first, which is maybe it would be better if we don't tell the world our strategy. But I actually think it served us very well, and it's helped bring along many of our most devoted clients and partners. So for at least the foreseeable future, we'll keep doing that. And I give that as preface to answer your question, which is we uniquely started with the fat head and not the long tail. We started with the biggest advertisers in the world, and we had the belief that if we could win the trust and do well for the biggest brands in the world, that it would make it easier for us to do that with mid-size and smaller. Incidentally, I think the acronym SMB, small and mid-sized business, is only useful in the sense that it makes it digestible, but mid-size are as different, if not more different than small, than the large are to the mid or to the small. So there are at least three categories. But if you just look at it as there is essentially this like ski slope where you start with the very largest, which are very big and they spend a lot of money, and then just go down to those very small, we are working our way down that slope. And we have ambition to service all of it. We recognize that servicing M's and S's are very different than servicing the L's that we focus on today. But we also know that if you figure out how to serve them well, and they're very tough critics, they have very high demands. If you figure out how to service them well, then you can use those same tools. Of course, you get rid of all the questions and the dials that you give to the.
All right, I'm switching to Chime. That was great, and learned a little bit there. But this is the first ever earnings call, so I want to take a listen here.
Experiences to address each of these needs.
Our website between our GAAP and non-GAAP results can be found in our earnings release practice filed on June 12th, 2025. Forward-looking statements represent.
As you'll hear today, we're off to a very strong start. I'd like to begin by expressing my gratitude to our members for placing their trust in us, and to our employees for their hard work and dedication that brought us to this moment. Over the past few decades, major industries like transportation, hospitality, and retail that were once dominated by legacy players have been upended by customer-obsessed technology companies.
To grow for as far as we can.
New entrants offered consumers better experiences at lower prices, earning the trust of millions, and in the process, 2 years, established a new. Over the last 2 years.
Like, why is it still
in
playing?
Q2, we grew active members 23% year over year.
Chime second quarter, we disclaim any obligation.
And to our employees for their hard work and dedication that brought us to this moment. Over the past few decades, major industries like transportation, hospitality, and retail that were once dominated by legacy players have been upended by customer-obsessed technology companies. New entrants offered consumers better experiences at lower prices, earning the trust of millions, and in the process, established a new generation of beloved brands. Their digital-first business models allowed them to quickly and efficiently reach massive scale. This same transition is happening now in consumer banking, and I'm proud that Chime has emerged as a clear leader with a mission to unlock financial progress for our members. We created Chime to help everyday people, starting with those earning up to $100,000 a year who've been overlooked by traditional banks. Not the unbanked, but the unhappily banked. Today, we're already the primary financial partner for millions, but our ambition is much bolder: to become the largest provider of primary account relationships in the US. And we're doing that as a technology company with a scalable and low-cost operating model, with a combination of recurring payments revenue, high gross margin, and very low credit risk. We've earned the trust of our members and will support them in all areas of their financial lives, across spending, saving, building credit, borrowing, investing, and more. With our modern tech stack and radical cost to serve advantage, we can deliver innovative, personalized experiences to address each of these needs for free or low cost. And by utilizing AI built on our uniquely rich data set, we're becoming an even more indispensable partner, deeply attuned to our members' individual needs, anticipating what's next, and guiding their financial progress every step of the way. And our vision isn't just aspirational. It's grounded in an attractive business model that's driving rapid growth at scale with strong operating leverage. In Q2, we achieved 37% year-over-year revenue growth, an acceleration relative to our seasonally strong Q1, when tax refund activity drives higher levels of re-engaged active members, purchase volume, and revenue. Our adjusted EBITDA margin rose to 3% in Q2, an 18 percentage point increase over the last 2 years. In Q2, we grew active members 23% year over year to 8.7 million, with the majority relying on Chime as their primary account relationship. Among US adults earning up to $100,000 annually, Chime is the top destination for those switching their direct deposit, thanks to our scalable, referral-driven acquisition model. Despite our scale, with less than 5% penetration, we're barely scratching the surface of the opportunity to serve nearly 200 million everyday Americans earning up to $100,000. Banking for this large segment of everyday people is an area ripe for disruption. In a recent shareholder letter, one of our nation's top bank CEOs reported that for low balance accounts, which make up the majority of their accounts, their cost to serve them are far greater than the revenue they earn. The reasons? First, high cost structures due to a combination of an in-person approach to service delivery, physical branches, and legacy tech. And second, their net interest margin or NIM-driven business model, which doesn't work for everyday Americans with low average balances and who often don't fit their credit box. Without NIM to cover their high fixed cost structures, incumbents charge consumers over $18 billion in estimated fees in 2023, 95% of which were paid by everyday American households. These are the people who are unhappy with their bank relationships and are coming to Chime. We pioneered a business model that succeeds when we earn our members' trust by designing products that are helpful, easy, and free. If they can't be free, we aim to be the lowest cost provider. This approach leads to a top-of-wallet primary account relationship, giving us a level of engagement and payments-driven monetization that we believe is among the highest in consumer fintech. Chime is not a bank. Our member deposits reside in regulated FDIC-insured accounts at our partner banks. We are an asset-light technology company obsessed with addressing our members' most critical financial needs. Our early progress has been fueled by 4 distinct competitive advantages that we believe will continue to expand as we grow. These are our low cost structure, our track record of product innovation, our primary account relationships, and our beloved brand. I'll now spend a few minutes walking through the progress we've made in each of these 4 areas in Q2. Our first competitive strength is our significant cost advantage, which allows us to serve customers at 1/3 the cost of a large bank and 1/5 the cost of a regional bank. This is fueled by our digital-first bank partnership model and vertically integrated tech stack. The recent introduction of Chime Core, our proprietary transaction processing core and ledger, has enhanced our cost advantage and accelerated our product development velocity. In Q2, we successfully transitioned all new debit and savings accounts onto our new system. Our tech stack was also designed to centralize our data, which facilitates the deployment of AI to improve member experiences, while also significantly reducing our cost to serve. In May, we launched our Gen AI voice bot to all members, which more than doubled our satisfaction scores compared to our legacy voice system. AI-powered tools now fully automate the majority of our support interactions and do the work of thousands of human agents. As a reminder, since 2022, we've reduced our cost to serve by nearly 30%. And over time, we think AI can power nearly all of our support interactions. AI is improving the way banking services are delivered, and we believe we're at the forefront. Our second competitive advantage is our track record of developing some of the most impactful product innovations in consumer banking and payments for everyday people. Last year, we launched MyPay, another hit product enabling members to access their earned wages on demand. MyPay is now an over $300 million annual revenue run rate product and another key driver of new member growth. In terms of risk, we made faster progress than planned on improving MyPay loss rates in Q2, which led to transaction margins for this product tripling in the quarter, and we expect further progress in the quarters ahead. Going forward, we think there's much more to do with MyPay, including our enterprise version offered through Chime Workplace, our employee financial wellness solution for employers. We expect to announce some of our early enterprise partnerships in the weeks and months ahead. Because of our strong performance across the business, including MyPay, we've raised our expectations for revenue growth and adjusted EBITDA for the rest of 2025 relative to our previous internal expectations, which I'll have Matt walk through later. In Q2, we also started scaling instant loans, our installment loan product, which allows pre-approved members to borrow up to $1,000 at affordable rates, repaid over a 3- and 6-month period. Early results are encouraging, and we observe higher engagement and retention among members who take an instant loan, reinforcing our long-term core spending relationship. Loss rates have been in line with our internal expectations as we continue our measured rollout. The final Q2 product update was our continued rollout of Chime Plus, our free premium membership tier. Chime Plus showcases the products our members unlock with direct deposit, like SpotMe and MyPay, combined with enhanced benefits, including exclusive cashback deals, a higher interest rate of 3.75% on savings, and dedicated member support. Early results here are promising. We're already seeing Chime Plus lead to higher direct deposit conversion and member retention rates. Chime Plus is just the beginning of a broader effort to show our members that as they engage more, they get more with Chime. Our third competitive differentiator is our success in earning primary account relationships with the majority of our active members. Our approach has resulted in what we believe are among the highest levels of engagement, long-term retention, and customer lifetime values in consumer fintech. In Q2, our average active member did 55 transactions per month with us and engaged with our app an average of 5 times per day, positioning Chime as the center of their financial lives. Our real-time view into the state of the everyday American consumer is showing healthy member spending and stable account balances. Even in an uncertain macro environment, our model focused on non-discretionary spend and short-duration liquidity products, as well as our privileged repayment position, is incredibly resilient. We grew our active members 23% year over year in Q2, while also reducing our member acquisition costs. We continue to see that over 50% of new members came to Chime from organic and member-driven channels, including referrals. And our members don't just like Chime, they love Chime. They're passionate about us, and they want to tell their friends about us. Our final competitive advantage is the market-leading and trusted brand we've built in banking and payments. We're now a clear leader with unaided brand awareness of 40%, rivaling the 2 largest traditional banks in the US and the go-to brand for the most critical needs of everyday Americans. Our brand building initiatives connect with culture. And in April, we celebrated Financial Progress Month, featuring partnerships with Deion Sanders, AKA Coach Chime, and WrestleMania. In June, we announced our newest brand ambassador, Cooper Flag, the NBA's #1 draft pick, with content that went viral on TikTok. We believe our combination of competitive advantages is only growing stronger as we demonstrated in Q2. And with that, I'll hand it over to our CFO, Matt, to discuss our financial results and outlook.
Thanks, Chris. Good afternoon, everyone. Thank you all for joining us today. I'm excited to discuss our second quarter results and outlook. As Chris noted, we had a great second quarter with revenue of $528 million, up 37% year over year, and continued adjusted EBITDA margin expansion. Given the strong performance across the business, we are raising our expectations for both revenue and adjusted EBITDA for the second half of the year relative to our previous internal expectations. Our Q2 financial performance was strong across the board. Payments revenue was $366 million, up 19% year over year, slightly ahead of purchase volume growth of 18%. Platform revenue totaled $162 million, up 113% year over year, as we continued to see very strong MyPay performance. Gross profit was $461 million, yielding an 87% gross margin, and transaction profit, which is gross profit less transaction and risk loss, was $363 million, yielding a 69% transaction margin, driven in part by our faster than planned progress on MyPay loss rates. Finally, we continued driving operating leverage with $16 million of adjusted EBITDA in Q2, a 3% margin, representing an 18 percentage point improvement over the last 2 years. Given this is our first earnings call, I'd like to take a step back and help connect our mission, strategy, and member-aligned business model to our financials. We believe there are 4 core elements that are critical to understanding our financial model. First, we have a payments-based revenue model driven by recurring, largely non-discretionary member spend. Second, we have multiple levers enabling us to drive rapid growth at scale across active members, average revenue per active member, or RPAM, and transaction margin. Third, our success earning primary account relationships drives strong unit economics with an estimated LTV to CAC of roughly 8x. Finally, our high transaction margin and a largely fixed OpEx base drives strong operating leverage and incremental margins. Let me jump into each of these themes. We have an asset-light payments-based business. 69% of our revenue in Q2 was payments revenue, earned from interchange-based fees on the purchase volume generated by Chime members using their Chime branded debit and secured credit cards. We believe the combination of scale and growth we've achieved on our purchase volume is unmatched in the industry. We are now one of the largest and fastest growing card portfolios in the US. In Q2, purchase volume totaled $32 billion, up 18% year over year, coming off our seasonally strong Q1 when members received their tax refunds. The important thing to understand is because our members use Chime as a primary account, this purchase volume is highly resilient and habitual, concentrated in essential, everyday, non-discretionary items like food, gas, and utilities. This drives durable, long-lasting cohorts in our business. It also gives us what we think is a very unique business model in our category. Compared to many consumer fintechs that primarily generate revenue from lending, consumer charges, or trading fees, our model generates high quality, recurring, and in our case, high margin payments revenue. Our model is very low credit risk. Mid-teens % of revenue was from credit and liquidity products as of Q2. And where we do extend credit, it's in a low risk way. Small dollar and highly diffuse among our member base. Short duration with average repayment periods of less than a week on SpotMe and less than 2 weeks on MyPay. And underwritten by direct deposits, which gives us both a data and first in line repayment advantage. We think our model is analogous to SMB payments and usage-based SaaS businesses, which monetize a core payments relationship and then deepen this engagement by cross-selling value-added services. The second theme is our multi-dimension growth opportunity across active members, RPAM, and transaction margin. In Q2, we grew active members to 8.7 million, up 23% year over year, while simultaneously bringing down CACs by over 10% year over year. One quick note, we see seasonality in our active members as well. Tax refund activity in Q1 results in a larger number of members re-engaging with us on an active basis, resulting in seasonally high quarter over quarter net adds in Q1 and lower net adds in Q2. 23% year over year active member growth in Q2 was in line with growth in Q1 and an acceleration from 2024. Great progress, yet still early days in our journey to serve the nearly 200 million everyday people making up to $100,000 annually in the US. Second is our RPAM profile, which we believe is among the highest in consumer fintech, despite very little of our revenue coming from mandatory fees. Our high RPAM is driven by our deep engagement and a top of wallet card position. As we've expanded our platform, we've grown RPAM significantly. In Q2, we grew RPAM by 12% year over year to $245, fueled by the continued breakout success of MyPay. We think there is still a massive opportunity ahead, certainly as we continue to add new products to our platform, but even as we continue to drive adoption across our existing product base. In Q2, our most engaged active members, those using 6 or more of our products each month, generated over twice as much RPAM as our average active member. Finally, transaction margin, our gross profit margin less transaction and risk loss, including losses related to our liquidity products such as MyPay and SpotMe. In Q2, our gross margin was 87% and our transaction margin was 69%. Over the last several years, driven by our investments in technology and increasing scale, we've grown our transaction margin substantially from 66% in 22 to 74% in 24. Starting in Q3 24, we brought our transaction margin down with the initial launch of MyPay, a positive but lower margin product compared to the rest of our business. A great example of the power of primary account relationships, we've already scaled MyPay, which we believe is the lowest cost earned wage access product in the market, to an over $300 million annual revenue run rate product. Now, as is typical for new credit products, and similar to what we saw when we rolled out SpotMe several years ago, as MyPay begins to mature, as cohort season, and as our underwriting improves, we're seeing MyPay economics improve substantially, and that's happening even faster than we planned. While our regular quarterly reporting will focus on overall levels of transaction risk loss, we wanted to highlight a few additional details of our MyPay economics today, given how rapidly the product is maturing. In Q1, MyPay loss rates were just north of 160 basis points of advanced volume. In Q2, we drove loss rates of approximately 140 basis points. Great progress toward our steady state loss rate target of approximately 1% for our existing MyPay product. This progress, combined with continued strong usage rates, is what enabled us to triple MyPay transaction margin quarter over quarter in Q2. We expect continued progress over the coming quarters, which is driving accelerated adjusted EBITDA margin growth in our guidance, which I'll discuss shortly. The third theme is our strong unit economics. The combination of our highly engaged primary accounts, our ability to effectively cross-sell and increase RPAM, and our strong long-term retention rates and transaction margin drive long-lasting cohorts of transaction profit. We have cohorts now nearing a decade old and still going strong. Our unit economics illustrate why we believe primary accounts are the most valuable relationships in financial services, driving differentiated lifetime values relative to single point solutions with more cursory levels of engagement. These differentiated LTVs drive strong and sustained returns on our investments in new member acquisition, enabling us to generate an estimated LTV to CAC of approximately 8x in our business today. The final theme is about how our high transaction margin and a largely fixed OpEx base enable us to drive strong operating leverage and incremental margins. In 2024, our incremental adjusted EBITDA margin was 46%. In contrast to incumbent banks, our digital asset-light platform allows us to efficiently scale our services over a growing active member base without needing to make massive investments in infrastructure or people. In addition, our OpEx base is heavily concentrated in discretionary investments in growth. These factors make our OpEx base very scalable and have allowed us to drive strong operating leverage across every OpEx category. In Q2, non-GAAP OpEx represented 66% of revenue, an 11 percentage point improvement year over year, and a 19 percentage point improvement over the last 2 years. That operating leverage has translated to meaningful adjusted EBITDA margin expansion, which we expect to accelerate in H2. Turning briefly to our balance sheet, we remain well capitalized. Net of transaction expenses and tax withholding payments made on vested RSUs, we raised $448 million in proceeds from our IPO. As of the end of Q2, we had $1.1 billion in unrestricted cash and marketable securities on our balance sheet. We also had $444 million available to draw under our revolving credit facility. Finally, turning to our third quarter and full year outlook, we're pleased to provide guidance that exceeds our previous internal expectations, driven by the broad business strength we're seeing. In the third quarter, we expect revenue between $525 and $535 million, resulting in year-over-year revenue growth between 24 and 27%. We expect adjusted EBITDA between $12 and $17 million, and an adjusted EBITDA margin between 2 and 3%. For fiscal year 25, we expect revenue between $2.135 and $2.155 billion, resulting in year-over-year revenue growth between 28 and 29%, and adjusted EBITDA between $84 and $94 million, and adjusted EBITDA margin of 4%. I'd also highlight a few things about H2. In H2, we expect our revenue growth to be driven predominantly by the continued growth of active members, following the strong growth in ROI we've seen to start the year. As a reminder, we began scaling MyPay in Q3 of last year. As a result, we expect platform revenue year-over-year growth rates to see some natural normalization in the second half of the year as we lap this initial rollout. What's really exciting is that, driven by our progress on MyPay economics, we expect the strong top-line growth we've driven over the last year to begin to really flow through to the rest of our P&L. with accelerating adjusted EBITDA margin growth in the back half of the year. We expect adjusted EBITDA margin to grow between 5 and 6 points year-over-year in Q3, ahead of both Q1 and Q2, with further expansion in Q4. On an incremental adjusted EBITDA margin basis, we expect to return to the mid-40s or higher by Q4, faster than we previously anticipated, and great progress toward our long-term adjusted EBITDA margin target of 35% or higher. And with that, I'll turn it back to Chris to wrap us up.
Thanks, Matt. Before we turn to your questions, I want to reiterate how proud I am of this team for raising the bar for core banking services in America. Our member-aligned model, track record of product innovation, and proprietary tech stack, now enhanced with AI, are meaningfully improving the user experience for everyday consumers while helping us build a loved and trusted generational brand. With that, I'll open it up for questions.
Thank you. And at this time, if you would like to ask a question, please press the star and 1 on your telephone keypad. You may remove yourself from the queue at any time by pressing star 2. In the interest of time, we ask that you please limit your questions to 1 question and 1 follow-up. Once again, that is star and 1 to ask a question. And we will take our first question from Tien-Tsin Huang with JP Morgan. Please go ahead.
Hey, good afternoon. Congrats again on the IPO and the first public earnings call for you guys. Glad to be on it. Just want to start maybe and ask you for an update on the strategy of widening the funnel and lifting restrictions. I know that was talked about during the roadshow and it's early, but are you getting the results that you wanted? Any interesting learnings or impact to gross ads or product attach, retention, that kind of thing?
Yeah, sure. Thanks, Tien-Tsin. Appreciate the kind words. I think coming out of a really strong Q1, which is obviously always a seasonally strong quarter for us, we continue to see great progress at the top of the funnel, 23% growth year over year in terms of actives, with lower CACs down about 10%. And so, we're growing these primary accounts while also successfully trying to drive earlier engagement. We talked about, as you indicated, was about our what we call our day one initiatives, trying to make Chime even easier to use right out of the gate. And so we have had some great success in terms of expanding our funding rails, making it easier to add money to an account as a new member, opening up Apple Pay, for example, mobile check deposit, and also providing introductory access to certain value props that historically have been behind the paywall, if you will, of direct deposit. So things like credit building and getting people using our P2P and these sorts of things before direct deposit. And the success has been great. We're seeing increased amounts of activation rates among enrollees and funding rates, which we feel good about, sort of increasing the size of the pond to fish in. We're seeing higher adoption rates of our credit building, credit builder card, which is good. As you know, that's a higher interchange product for us. So it's good for the business as well, while also being helpful for our members. And, I think this whole area of initiative is around the recognition that there isn't going to be a single path to converting people to direct deposit, which is always our number one goal. We know that some people are going to want to date a bit before they get married. And so we feel really good about this strategy. And I think you're seeing it in the numbers in terms of the ads at the top of the funnel.
Okay, great. That's good. Good summary there. Just my quick follow-up. I wanted to ask on MyPay, the transaction margin there, really impressive. Maybe give a little bit more on what's driving the momentum. Are you seeing higher attach, usage, and curious about sustainability, given, again, what you've learned so far?
Yeah, sure. Maybe I'll start and pass it over to Matt on the risk performance. But maybe just to level set, we're so excited about this product. We mentioned it's a $300 million run rate business already, just about a year in. And if you just look at the actual offering itself, with MyPay, everyday people have the opportunity to access to $500 of their paycheck on demand for free before the paycheck actually arrives. And if they want it instantly, they can get it for a low fee of $2. That's less than a cup of Starbucks. So the team's proven an ability to manage this product incredibly well in terms of the risk. But importantly for us is that not only is it a profitable product that's getting better, but it's also a really key element of the suite of value propositions for why people come to Chime in the first place. It continues to show in survey research and activation that this is one of the top reasons that people come to Chime. But maybe you want to talk to some of the success on the risk side, Matt?
Yeah, thanks, Chris. As Chris mentioned, we're very pleased with the continued progress on MyPay. And that's true both on the top line, but also on our margin and loss rates specifically. We did see attach rates on the product tick up sequentially quarter over quarter. That's driven by the continued strong interest in this product among our member base. But what I will say there too is there's also a little bit of seasonality here. Seasonality with respect to the usage of our liquidity products. Utilization of liquidity products does tend to be a touch lower during Q1 after members have higher balances when they receive their tax refunds. But in general, we're seeing very strong and continued great product attach. But as I mentioned in our earlier prepared remarks, what's really exciting is our faster than planned progress on loss rates. And that is, again, what drove loss rates to closer to 140 basis points in Q2 from just over 160 basis points in Q1. And again, great progress towards what we think is a more reasonable steady state loss rate on this product of approximately 1%. And so when you put that together, the loss rates plus continued strong engagement, that's what's enabled us to triple our MyPay transaction margin quarter over quarter. In terms of what's driving that, I'd point out a couple of things. Number one, this is sort of the natural evolution of a new credit product. As cohort season, as the product matures, loss rates do tend to improve. So I think we're just sort of following a natural course there. But we're also improving our underwriting as we learn on this product and iterate on it over time. And if I sort of zoom out for a second, it's really the same playbook that we use for SpotMe, where we actually saw about a 50% improvement in loss rates today versus when we launched the $200 version of that product. So we're really excited about this progress. And again, that's a key reason behind why we've raised our expectations for adjusted EBITDA margin growth in the back half of this year relative to our previous internal expectations. And as I mentioned, we expect to return to the mid-40s or higher incremental adjusted EBITDA margin by Q4.
All right, well done. Thank you.
Thank you. And we will take our next question from James Faucette with Morgan Stanley. Please go ahead.
Great. Thank you very much. And want to echo the congratulations on being public and all the work that's gone into getting to where you are today. Want to follow up on, Matt, just kind of your comments around loss rates on MyPay, et cetera. Really impressive performance here in the last quarter. And appreciate wanting to get those loss rates down to 1%. But how are you thinking about the pace that makes sense to get them to those levels versus using MyPay as an effective way to grow and engage with new customers and expand engagement with existing customers? Just trying to make sure that we're kind of level set correctly in terms of how quickly we should expect that to continue to improve.
Yeah, thanks for the question, James, and appreciate the comments there as well. So, a few thoughts here. You're exactly right. We control the dials here on MyPay loss rates, and I think the journey that we're on here is continuing to iterate between continued improvement in loss rates and making sure that the member experience on MyPay is best in class and everything that our members would expect. And so, that certainly may mean that the trajectory on loss rates may or may not be linear. And we, oftentimes want to make sure that we're looking at the holistic picture. If there's ways to, offer a little bit more member impact on MyPay that can drive bigger impact to our overall business in terms of engagement, retention, or direct deposit attach, those are trade-offs that we would make all day. That being said, given the faster progress that we've seen on this, I don't think you should think about that 1% loss rate as a long-term target. This is really a level that we could foresee getting to really in the quarters ahead, the medium term. And so we're quite excited about the progress here overall.
Good. Yeah, that should be really exciting. And then Chris, I wanted to ask just in terms of, obviously MyPay as a product has a lot of potential as a way to engage with enterprise. And I know that you've talked about enterprise and workplace initiatives to help grow engagement for potential Chime members, et cetera. Can you give us an update on that initiative and kind of the milestones we should be tracking over the coming quarters as to its progress?
Absolutely. Thanks, James. Appreciate it. For this one, I'm going to pass over to Mark Troughton, our COO. He looks over this part of the business and is closest to it. So why don't you take it, Mark?
Thanks, Chris. Hi, James. Yeah, I think just to level set for everybody on the call, Chime Workplace is the division of Chime where we deliver our products as a free employee financial wellness solution through large enterprises. And, we use Workplace to partner with employers. And the goal here really is to unlock a new acquisition channel for primary accounts for Chime. I think it's fair to say that, we continue to be increasingly excited about Chime Enterprise and Workplace. And we have a team there, a well-established team that actually pioneered the whole enterprise sale of earned wage access products. The team has built a strong pipeline. We have launched a number of partners. And I think it's fair to say that so far what we're seeing there is, in terms of adoption and satisfaction, is actually exceeding our expectations. So, we don't have any specific announcements to make today, but we hope to be sharing more here in the coming weeks and months.
Very good. Thanks, everybody, and have a good day.
Thanks.
Thank you. And our next question comes from Will Nance with Goldman Sachs. Please go ahead.
Hey, guys. Thank you for taking the question and echo the other congrats on the call so far about the IPO and around the first quarter out the gate. Awesome to see. I wanted to ask on just some of the spending trends that you guys saw in the quarter. I think if we look at kind of spend volume per customer, that number has been down kind of low to mid single digits the last couple of quarters. And I know, I think Tien-Tsin asked about the widening the funnel initiatives. And so I'm sure there's some mixed dynamics going on there. So wondering if you could talk about that trend and help us decompose that a little bit. What are you seeing on the underlying spend levels per customer? And just for modeling purposes, how would you help us think about kind of that metric on a go forward basis? Thanks.
Sure. Maybe I'll take that, and then Matt, if you have anything to add. Maybe just some context here. We are now at an over $130 billion run rate in terms of purchase volume across our portfolio. So back in 24, that would make us, just on our debit card portion, the sixth largest debit issuer in America, growing at a rate that's, compared to the rest of the top 10, our rate of growth is 9 times faster. So we've achieved very nice scale and also continue to grow. It is true that as we add new actives at the top of the funnel and push our service offerings so that people are able to engage with us in a lighter weight way out of the gate, that on a per active basis, average spend per active came down a little bit. We think this is and early results show that this is an investment worth making, because we know that not everyone is going to immediately convert to direct deposit. So we think that this is a good investment for us. I'll also just highlight that we are a nominal payments business, so we've benefited from some inflationary tailwinds over the past few years. Inflation was something like 8% in 2022, and now down to a little under 3%, 2.7% in June. So that provides a little bit of headwinds in terms of like the actual spend per customer that happens. But we're going to continue to invest in what we have from the earliest days of this company, from day one, which is developing people into primary direct deposit relationships, because we know that that's the best way to develop aligned long-term relationships and be able to unlock the best product experience for them. So, I think, you may see a little bit of choppiness from quarter to quarter. But at the end of the day, the amount of spend that we have on our active member base is, I think significantly higher than you'll, typically see in the industry.
Yeah, just to add to this, to quickly comment on overall spend trends as well as we're seeing very steady trends. So if you take a look at our primary account users, our more tenured users, you're seeing continued growth in among those users. So the per active metric that you referenced here is really just driven by mix shift. And so I think the high level trend that you're seeing in our business of a steady spend, stable trends is very much aligned with I think what you're hearing around the industry at this point of a healthy consumer, and that's true both across discretionary and non-discretionary categories. Of course, we are a heavily concentrated non-discretionary spend business. We help our members pay for their everyday expenses, which is steady regardless of the cycle, but again, we're seeing steady trends really across the board.
Awesome. Appreciate all that color. And then just on the MyPay outside the direct deposit base initiative, was wondering if you could comment on some of the proposed bank fees that are out there. Does this have any impact on just the unit economics or cost structure of that product? And just any thoughts on whether that is meaningful enough to kind of change strategy or pricing there?
Yeah, maybe just to comment on that pricing proposal. One of the banks proposed pricing for access to data. Look, we believe that consumers should have the ability to move their data to whatever service provider they want without having to incur fees for it. I think we're quite a bit different than most fintechs out there in that we own the primary account relationship, so we are the ones that actually have the data, and the majority of our deposits are coming to us from that direct deposit relationship. So I don't think that if that change were to happen, it wouldn't affect us. And it sounds like based on what the CFPB recently came out with, that pricing actually isn't going to happen anyway, or is unlikely to anytime soon. But as it relates to our MyPay Day One, MyPay Day One is just one experiment that we're trying at the top of the funnel, again, in the vein of trying to make interacting with Chime, getting access to some features from the early days available to members before they engage with direct deposit. Any potential changes would have, essentially, negligible impact on that product, which again is an experiment that's part of a broader suite of services available to people from the outset of the relationship. But we'll be learning more over the course of this quarter and beyond on the effectiveness of that product and how effective it is in getting people to ultimately sign up for direct deposit and primary account relationships.
Awesome.
I think just to add to that, it may be also worth just saying that, look, if we don't think this is going to happen, but even if charging for access to banking transactions became the industry norm, the reality is that is probably a net benefit to Chime as somebody who has a lot of primary account relationships. So we really don't see this idea of charging for access as having any sort of negative impact on Chime at all.
Great. Appreciate that clarification, and thanks for taking the questions today. Nice job today.
Thank you.
Thank you. And once again, if you would like to ask a question, please press the star and 1 on your telephone keypad now. As a reminder, in the interest of time, we ask that you please limit your questions to 1 question and 1 follow-up. And we will take our next question from Darrin Peller with Wolfe Research. Please go ahead.
Hey guys, thanks, and congrats on the first quarter out. I want to understand a little bit more your thought process going forward now that you've had some really good success for about a quarter to 2 quarters on the ungated new users, ungated to direct deposit that was touched on before. How do you think about the mix going forward around that, your strategy? And then I guess, how does that play into what we should think about modeling CAC? It was obviously down, and there's been really good word of mouth that's been driving a very strong CAC for a while. Down 10% year over year again. I guess I'm just curious if that plays into it to some degree. But more importantly, just as an add-on, how do we model that? How do you want us to model that going forward?
Thanks for your question, and I'll take it if you want to add to that, you can. But like I said, we feel really good about this strategic decision to make Chime easier to use right out of the gate, and I think the key for us is a combination of giving people that are new to the story, new to the platform, giving them enough to get a taste of Chime services, but also at the same time make it clear that as you engage with Chime and you do more with us, you're going to get more from us. And that's really the strategy behind products like Chime Plus, which really is an effort to package all of the best features of Chime that you get when you engage with us as a primary account holder, using direct deposit, getting higher rates on your savings account, getting access to these core liquidity services of MyPay and SpotMe, and additional benefits and services. You're going to continue to see from us an investment into ways to make Chime more accessible for people out of the gate, but also even more rewarding to our members as they engage with us. So we think creating this larger pool of members to engage with us is a decision that makes sense. It's a natural one for us, and especially as we layer on a suite of offerings that get better as you engage more, we think it's a natural win-win. We still have lots of people that come through the top of the funnel and have already decided that they want to switch their banking to Chime, and others that are going to engage in a lighter wait for a period of time. And look, the top of the funnel and the cost save on that side is the result of just great execution from our product and marketing team, opening up new channels, new video channels, using AI at the top of the funnel, having even more success with member referral programs. I mean, that's what's really driving our success at the top of the funnel and the efficiency that we're having in that area. And we're going to keep pushing on that because we really like the ROI on those investments.
What I'd add to that, Darren, is in addition to the great progress on CAC, is we're also driving higher LTVs. You're really seeing that in the growth in RPAM, as an example, growing 12% year over year in Q2. And so when you put these things together, what you're seeing is improvement in our already strong unit economics, and they're translating to payback periods that are now more in the zone of 5 to 6 quarters for our most recent cohorts, compared to 7 quarters that we mentioned, in our S1 a few months ago. And those payback periods support longer term LTV to CACs of 8x or higher.
Thank you. And we will take our next question from Timothy Chiodo with UBS. Please go ahead.
Great. Thank you for taking the question. I want to see if we could circle back to Chime Workplace again a little bit and dig into a little bit just to bring it to life. So clearly you've stated that it's going to be a great low CAC channel, brings in a lot of members, and I think the beauty of it is it kind of replenishes itself as those employees who have Chime accounts move on to other jobs. They can stay with you, and it kind of replenishes. So it seems like a great channel. I wanted to see if you could bring to life a little bit more the conversations with these large enterprise merchants. I know you mentioned there's a few over the next few weeks that you might be able to announce, but when you go in and speak to them, I mean, what is the status quo? Are they speaking to competitors? Are they maybe using a competitor? Is this totally new to them? Is there any pushback, or is it just sort of inertia and where it falls on their priority list? Thanks a lot.
Yeah, sure. That's a great question. I think in terms of, are they new to the category versus do they have an existing provider? I think a lot of them are new to the category because penetration is still really low in this market. But there obviously are some that we're speaking to who have an existing provider and maybe considering a switch. So I think that probably gives you an indication there. I think, it's probably worth discussing what we think our sort of competitive advantages are and why we think they're actually open to the calls and why we think we actually stand a chance in this channel. And really, there's a few things. The first one is, historically, this market has been approached by people who are just offering earned wage access. It's a sort of narrow point solution. And really, our solution is much broader. It's offering broader financial wellness part of which is earned wage access, but it goes beyond into credit building and savings and broader financial health. And so when we chat to an employer, we're actually able to address not only the portion of the employee base that's interested in earned wage access, which may be 30% or 40%, but actually we're able to address 100% of their employee base, number one. Number two, if you just bring it back to the earned wage access piece, our belief here is that our offering is superior to the extent that we are offering up to 100% access to 100% of wages without any fees at all. Just to remind people on the call, the Chime Workplace option actually is different to the consumer option. We offer up to 100% of earned wages with no fee, irrespective of whether you want to receive it immediately or delay. That offering is absolutely unmatched in the market and really compares very favorably against other earned wage access providers who are charging $3 to $4 per draw, where members may be paying $40 a month, and with the top quartile may be paying in excess of $70 or $80 a month. So that's a strong advantage for us. And then I think the third core advantage there for us is really the Chime brand and our install base, where, given our scale and our install base of customers, we're able to drive greater adoption and satisfaction through this. So we think those are the advantages that are resonating today in those sales calls. But as we'd indicated earlier, we're not at the point here where we're going to be discussing specific customers and partners that we've launched. But we do hope here in the coming weeks and months to be able to share more specifics with you of the progress in the channel.
Thank you. And our next question comes from Andrew Jeffrey with William Blair. Please go ahead.
Hi, thank you for taking the question. Great to be involved on this first public call. Matt, I had a couple questions, actually. One's housekeeping. Could you give us a sense of what you think interchange rates are going to look like? I know that's a function of mix between credit spend and debit spend, as we think about building our models for the rest of the year. And then also, could you give us the fully diluted share count just so we can calculate enterprise value correctly?
Yeah, thanks, Andrew. Appreciate the questions. So, on the interchange rate side, I think what we're seeing there in general is a lot of stability. So, what you're seeing on a year-over-year basis in Q2 was a slight uptick in rates relative to the year prior. But in general, our expectation is for stability, across both debit and credit volumes. Of course, credit earns significantly higher interchange rates versus debit. This is for our secured credit card. And so, that remains a big opportunity for us as we continue to drive adoption of our credit building services for our members. On the fully diluted share count question, what you'll see in our filing is a share count of approximately 370 million. That's our issued share count as of the end of Q2.
Thank you. And we will take our next question from Sanjay Sakhrani with KBW. Please go ahead.
Thank you, and congrats again. I had a question about RPAM. Strong growth in the second quarter, excelled a bit versus 1Q. I know MyPay and other initiatives are going to help. Just curious how we should think about the growth trajectory over the course of the year and into next. Maybe, Matt, you could help us with sort of how the sequencing of that would play out over the course of that time.
Yeah, thanks, Andre. Happy to take that one. So a couple quick thoughts on this. The first, what I would say is, we've certainly benefited on the RPAM side over the last year from the launch of MyPay. That's been a key contributor of our growth in RPAM over the last 4 quarters. Naturally, we are now facing the sort of 1-year anniversary of the launch of MyPay. And as a result of that, you should expect some natural normalization of our RPAM growth rate as we lap that initial launch, which again was in Q3 of last year. We ramped throughout the course of Q3. So in Q2 25, we're sort of growing off of a lower base versus Q3. And so that's I think the progression there on the RPAM side. But I just sort of say on top of that, of course, that we're really excited about is, again, after driving such strong top line from MyPay, what we're now expecting over the course of the second half is, again, for that strong top line to really start to flow through the rest of our P&L. And again, that's a key reason why our guide is calling for an acceleration to our adjusted EBITDA margin growth in H2 relative to H1. As a reminder, we expect adjusted EBITDA margin expansion to accelerate about 5 to 6 points year over year in Q3. That's ahead of both Q1 and Q2 of this year. And we also expect even further expansion in Q4. And again, on an incremental adjusted EBITDA margin basis, we expect to return to the mid-40s or higher by Q4.
Yeah, that's very helpful. And I guess like my follow-up was actually on the margin. I mean, Chris mentioned AI. Obviously, that could be quite enhancing to efficiency. The strong incremental margins that you have. What kind of timeline do you think we could expect to get to sort of the longer term goals that you have on the operating margin? Like, what do you think it can happen over an intermediate term? Thanks.
Yeah. So as a reminder, we think that on a more steady state basis, our adjusted EBITDA margin should approach 35% over time. And I think that the progress that we've made, on EBITDA margin growth the first half of this year and our expectations for the back half of this year, again, returning to mid-40s or higher, and gives us a strong line of sight to get to those levels. The other thing I would say is, the path that we take there, I think also depends on our levels of growth investment. Such a significant portion of our OpEx are based off discretionary investments in growth. And so, we have the dials there to trade off over time as well. So, you should not think about that as a decade-long target for us. But of course, we're going to continue to invest in this business over the next couple of years as well.
Thank you. And it appears that we have reached our allotted time for questions. I will now turn the call back to Chris Britt for closing remarks.
Appreciate it. And I just want to thank everyone for joining the call today. We look forward to spending more time with you in the weeks and months ahead.
Thank you. This does conclude.
All right. Okay, great. So that is very interesting. Now, I want to talk about the trade desk. I want to talk about mainly Chime as well, because that was the first quarter that we ended up seeing that quarter, or the first quarter that we ended up seeing their earnings. Sorry. But I have to go live again at 8 o'clock, which is in 1 hour. What I'm going to do is end up doing two things, because there's been a big change since I've been public, or since I've been live. Oh my gosh, I'm all over the place right now. SoFi has released their 10Q, which gave us a lot of new information. I want to end up going through that tonight. I also want to go through a comparison between Chime and SoFi. So I want to do that again, or do that for tonight, because now we've seen both Q2 earnings. We've seen website traffic. We've seen all of these things. I want to compare the valuations. That is very interesting. But overall, the trade desk down 29.3% right now in the after hours. Chime is relatively flat, just down 0.44%. The big winners of the day, wow, everything looks kind of shot. Soundhound down 12.8%. JFrog up 16. Expedia up 16.9. I think they take it. Instacart up 9. No, Accelera up 20.5%. Whoever donated that to me in the community fund, Mwah! Thank you. Appreciate that. But until next time, really do appreciate your time. Thank you for the listen along, but I'll have to explain it in a later live stream. Bye for now.